Okay, so my dear friends, this problem from the RTP is on commercial papers. I don't know whether to classify this problem as security valuation chapter or bond valuation chapter or interest rate management chapter, but this was not there when the syllabus was drafted initially. A couple of iteration backs when they issued the new study material, they've included this variety also. Let me read the problem and then I'll try to solve it. From the following information, compute the effective rate of interest per annum as well as cost of funds to Nirmal Limited, which is planning to issue a commercial paper. Issue price, face value, maturity period, issue expenses, brokerage, rating charges, stamp duty. Okay, now what is this commercial paper concept means? And in case of government, a similar thing is called as treasury bills, T bills, 91, 364 T bills. Normally, in case of bonds, there are two things, right? One, the holder will receive coupon periodically, and on maturity, he will get redemption price, coupon and redemption price. But if the period is less than 1 year, if the loan period, if the term is less than 1 year, there is no coupon paid, there is only redemption price. And that is what is called as commercial papers. When a company issues, it's called as commercial paper. When the government issues, it's called as treasury bills. And how the investor will make money, not by coupon, is difference between the issue price and the redemption price. In this case, the issue price is 4,87,000. Redemption price means face value, and the difference is the income. So, what is the effective rate of interest if I have to calculate? Or if I have to calculate what is the nominal rate, what is the rate of return? Let me calculate what is the rate of return for investor. Simple formula, return on investment. The redemption price, the face value, I'll call it as F minus uh, the issue price, which we can call it as P, means a present value, issue price, and divided by what I should do. Should I divide by F or I should divide by P? Return on investment. The difference between the redemption price and the issue price is the numerator, return, profit. Denominator is the investment. The investment is not 5 lakh. Investment is issue price. So I divide by P. P in this case is issue price. Multiplied by 100. You express in percentage and convert this into annual terms. Now this is for how long period? This for 3 months and you annualize it for 12. So divide by 3 and multiplied by 12. The rate of return for investor, and that is F 5 lakh minus P 4,87,750 divided by P, which is 4,87,750 into 100 into 12 by 3. So you will get, I think, 10.05%. Yes. Okay. This is actually called as nominal rate of interest per annum. This is per annum. But this is 3 months, right? So we simply annualized it. That is absolutely fine. This is actually called as nominal rate. Effective rate means if it is compounded quarterly, how much will be the annual rate of interest if it is compounded annually. So effective rate of interest, I mean, if it is compounded quarterly to annual terms. Why quarterly? Because this is 3 months. So effective rate of interest is, at present what you get is compounded quarterly. because 3 months once, right? Compound quarterly, you make it annually. So for that, the formula what we use is 1 plus whatever the rate of interest I got, that whatever I got or whatever r, divided by frequency. I'll just divide by t, the frequency, to the power of t minus 1. What is the logic? We follow multiplicative model. 10% is for the full year. So for the quarter, how do I do? 10% divided by 4, 2.5%. So first quarter to second quarter to third quarter to fourth quarter. 1 plus r, 1 plus r, 1 plus r, 1 plus r. Multiplicative model. And that's the formula it looks like. So 1 plus rate of interest is 10.5, 0.105 divided by t. T represents the frequency of compounding. Frequency of compounding. If it is compounded quarterly, 4 times. Compounded yearly, compounded half yearly, 2 times. And whatever you divide, same thing in the power. To the power of 4 minus 1. So 0.105 by 4. So 0.02625. So 1.02625 to the power of 4 minus 1. Plus 1 into equals minus 1. 0.1092. So 10.05. So not 0.105, 0.1005. So 0.1005 divided by 4 plus 1, 1.02. 5125, sorry, 0.02 5125 into equals minus 1. I think you get 0.10435. 0.10435, or you can say 10.435%. Yes, 10.435%. Okay, this is the rate of return only considering interest, the difference between issue price and redemption price. But they also asked what is the overall cost of funds. Cost of funds means other expense also to be taken, brokerage expense, rating charges, stamp duty, everything you just convert to annual terms. So cost of the funds, we'll calculate it as effective rate of interest plus brokerage plus stamp rating charges and plus stamp duty. So effective rate of interest is 10.435. Brokerage is 0.15, but that is for 3 months. So 0.15, I'll multiply it by 12 by 3. Basically, I'll analyze it. Rating charges 0.55, so that I can take it as it is. Plus stamp duty is also for 3 months, 0.20 multiplied by 12 by 3. Please simplify all these things and see how much you get. And see if you get approximately 12.385. Hope you're getting it. So 12.385 is the effective cost considering the interest expenses and also the other expenses. Okay, very good, great. I hope you got the question. This is a question on comprehensive problem on bond valuation from RTP May 2023. So please confirm you got the question. Yes, okay. I just want to confirm it. Let's read. The following data available for a bond: face value rupees 10,000 to be redeemed at par on maturity, coupon rate 8% per annum, years to maturity 5 years, yield to maturity 10%. You are required to calculate current market price of the bond, Macaulay's duration, volatility of the bond, convexity of the bond, expected market price. If there is a decrease in YTM by 200 points, by Macaulay's duration estimate by intrinsic value methods. Okay. Now let me give that basic idea of the calculation quickly, conceptually, then we'll go for numericals. So in bonds, bonds is nothing but an instrument of debt where one person pays interest, other person receive interest. Here it's called as coupon. So in this case, the number of years is 5 years, years to maturity 5 years. So year 1, year 2, year 3, year 4, year 5. There are 5 years, and these 5 years I'm going to do, I pay coupon. And how much coupon? 10,000, 8.5%. So I think you get 850, right? 10,000 into 8.5%. You get 850 every year. 850 every year. And last year, there also be redemption price. So what we do in bond valuation, the rate of interest from the investor point of view, even though 8.5% is paid, that is not considered as rate of return. Why? Because in the market, the rate of interest keeps fluctuating. RBI comes up with repo rate, monetary policy committee, they keep making changes. Fed in US keeps changing the interest rates based on inflation, based on the economy level. So when they change the base rate like that, any further interest rate investors also will expect based on those prevailing conditions. But this coupon rate cannot be changed. See, for example, when the bonds were issued, it is 8.5% in the market. So bond is also having a coupon of 8.5. But 1 year later, RBI changed the interest rate, and throughout the market, a rate of interest increased. Now 8.5% people are not happy. They want 9% now. But it's a contract. It is valid till maturity. Are you getting the point? You need 8.5%. I mean, you are getting 8.5%, but you need 9%. So where do you get that extra 0.5%? You will make that adjustment in the market price. You pay less and you get that extra 0.5 return. You achieve that extra 0.5 return. And therefore, the rate of return you get is in two forms. One, the coupon, what you get, and the another is the market price and the redemption price difference is also your income. and that is what is called as YTM, yield to maturity. Anyway, in this problem, yield to maturity is given. So anyway, so conceptually, what is this? So we have these coupon of year 1, year 2, year 3, year 4, year 5, and last year you get redemption price. So this you don't treat as income because 850 is also income, and in 10,000 the difference between the market price and the redemption price also becomes income. So do not treat these things as income, treat these things as cash flow, and you discount this cash flow, you discount this cash flow. The present value what you get, that is called as value of the bond. So keeping the cash flow from the bond, discounting rate will be required rate of return. The present value what you get is called as value of the bond. So what is value of the bond? It is the present value of the coupons and redemption price. Okay, now, sir, there is so many terms, sir. What is YTM? Then what is required rate of return? Okay, let me tell you this. This is discounted at what rate? Value of the bond is discounted at required rate of return. Correct? That's what I just told you. In the market, rate of return changes, so my expectation also will change. So when the discount rate is my required rate of return, the value of the bond is what I get. Everybody's required rate of return might change slightly, and therefore value of the bond is also different for each person. So when it is required rate of return, what you get is value of the bond. Instead of value of the bond, if I make it as price, market price, what is the market price? Same thing. It is present value of coupons and redemption price, but discounted at what rate? Discounted at the rate of return will change, right? If the value and price both are equal, it's okay. If it is not equal, then that discounting rate is called as YTM, yield to maturity. I hope you got the concept. Very simple. I'll repeat once more. When the discounting rate is required rate of return, the present value is called as value of bond. When the discount rate is yield to maturity, the present value is called as market price. So quickly write down these points. If you have any doubts, please ask me. I'll go for the actual calculations in the next step. And let me know once it is done. Done. Very good. That's great. Okay. Now, let's go for the calculation now. Look at the problem. They have given the yield to maturity, yield to maturity 10%. We have yield to maturity 10%. And therefore, if I do a present value, what you should get? I should get market price. Let's discount and every year cash flow is same. So I can use annuity factor. But in the problem, I should also calculate Macaulay's duration, volatility. So their anti-factor will not help us. We need to calculate every year separately. So let's go for year by year calculation separately. So year, I'll call it as X. I'll come to it later. Why is that called as X? Year 1, 2, 3, 4, 5. First year I get coupon of 850. That is, 10,000 into 8.5%. Second year 850, third year 850, fourth year 850. Last year you get 10,000 and you get coupon, redemption price and coupon. So 10,850. And discounting factor at the rate of 10%. So 1 by 1.1, you get 0.909, and usually they will give these factors in the problem, so they can take it as it is. So 5-year discounting factor, multiply, you get the present value. Cash flow into discounting factor, the present value you get 850 into 0.909, you get 772. 850 into 0.826, you get 702, and so on. The total price comes to 9431. That is the answer to the first question. Current market price 9431.5. When the discounting rate is YTM, the present value is market price. Please write down till there. Okay. One observation now. What was the face value? 10,000. What is the market price? 9431. Market price is less than the face value? Correct. Could we have predicted this before calculating that the market price will be less than face value? Yes, we could have. How? Please observe. What is the coupon rate the bond is offering? 8.5%, correct? The coupon offered is 8.5. That is what the company is paying. The rate of interest what company is paying is 8.5. But what is the rate of interest that you expect from the company? 10%. That is right. You are getting 8.5, but you need 10% because the markets, the rate of interest have gone up due to market conditions, or the company stock or company would have become more riskier, some bad news, due to which you are expecting more returns. Now, coupon is fixed one. Until maturity, coupon cannot change, but you need that 1.5% extra. Where is that 1.5% extra you get? By way of paying less. Your purchase price will be less. You pay only 9431 and you redeem at 10,000, you get redemption at a higher price. Capital gain you get. Redemption at a higher price, you get that gain. Thereby, you achieve that 1.5% extra return. In other words, what is that? logical concept you have to keep it in mind. The discounting rate and the present value are inversely related. The coupon and the YTM and the current market price are inversely related. So you can say that if coupon rate or if required rate of return, or in this problem we say YTM, if YTM is greater than coupon rate, like in this case YTM 10%, coupon rate is 8.5. If YTM is greater than coupon rate, then the present value market price will be less than face value, will be less than face value. And not only that, I told you that the YTM and the market price are inversely related. So on y-axis, if I take it as YTM, and x-axis, if I take it as price, and it is inversely related. As the YTM increase, the market price decrease. YTM is a discounting rate, price is the present value, and the discounting rate and present value are inversely related. One increase, other decrease. You expect more and more, the price will come be, value will be less and less. Because you expect more means, how do you achieve that return? Only by paying market price. So you can also note down those charts quickly. And it is not a straight line. You can see I've written a curve. So it's not a linear relationship, it is curvy linear relationship. Why is it so? Because 1% up and 1% down is not same. If discounting rate 1% up, what change happens in price? And if a discounting rate 1% down, what change happens in price? They are not same. So please write down these points also. If YTM is more than coupon rates, market price will be less than face value. And you write down this relationship also, that is price and YTM inversely related. Price and YTM inversely related. And they are non-linear. Non-linear. Okay, I hope it is done. Good. Now, why I'm stressing upon that point non-linear? Because if I say there is, of course, the inverse relationship, we would like to understand, right? By how much? If the YTM increases by 1%, by how much the price will fall by? That is called as volatility. We are going to look at the formula for it. But if I tell you, what are the formula for volatility? Basically assumes a linear relationship. See, when the line is like this, you can say it is linear. When the line is like this, it is non-linear. But if I say some simple like this, now this point, even if I zoom it, can you tell me, is this one linear or non-linear? You can't make it, right? When the change is small, we cannot make difference between linear and non-linear. So we are going to calculate linear relationship, straight line relationship. That's called as volatility. So what is volatility? Volatility is a linear measure of relationship between YTM and price. If YTM changes by 1%, the price will change by how much percent? In fact, that is a ratio, that is number of times. Sir, you told it is non-linear. Correct. Volatility is linear, but rate of interest usually will not change too much, right? It will change by 0.1%, 0.25%. So small change is sufficient to understand its impact. So volatility is measured using linear relationship, even though actual relationship is non-linear. Anyway, I hope you got these points. We are going to calculate those things and we'll interpret. But before we go to volatility, there is one more thing called as Macaulay's duration, or simply called as duration. So what is duration? Duration is the holding period. Sir, very simple, sir. Holding period is 5 years. No, not like that. 5 year is the remaining time to maturity. But are you getting the cash flow in one time? Yes, that happens in zero coupon bonds. But in this bond, first year I'm getting some amount, second year I'm getting some amount, third year I'm getting some amount coupon, fourth year some amount, fifth year big amount is coming. So when I'm getting back the money in many periods, I would like to convert this into one average period. That average is called as duration. But I cannot take a simple average because amount received is different in different periods. So we are going to take a weighted average, and the weight is the amount. The average is the number of years. I repeat this once more, sir. Okay. Duration is the average holding period. It is trying to understand within what period the amount is recovered. And we are going to calculate an average and not a simple average, a weighted average. Now, please keep it in mind. When we calculate average, we always give one X column, and for the weights, we give W column. Sir, how do you decide as year as X column and W as present value column? Correct? Weighted average means you multiply the amount with the weights. Now, if I want to calculate average marks, you call like X bar, right? There's a formula for average. X bar is like summation X divided by N. Sum of all the observations divided by number of observations. Now, if I want to calculate average marks, then which column you give X as the heading? For the marks column. You want average age? For the age column. If you want to have it for average salary, the salary becomes X column. You want to calculate the average holding period, so the period becomes the average column. And the amount is going to be the important one, in the sense it is varying from period to period. So amount becomes the weights. So a weighted average here, X column is year and W column is present value. Or some people institute, what time they do is they take proportion of this. They make it into weights in decimals. 772 by 9431. Like that, they convert it to percentage and then they multiply. Same answer you get. And there is a direct shortcut formula is also there. 1 plus YTMC, that formula shortcut is also there, but I'll not go behind those things now. I'll just use this standard method which I adopt. So let's do a weighted average. So multiply the column, that is 1 into 772. So what is the weighted average formula is going to be? X bar will be summation XW divided by summation W. Product divided by total of weights. So multiply 1 into 772, you get 772. 2 into 702, you get 1404, and so on. And total 40103.35. And that becomes summation XW. But what is the formula? It is going to be summation XW, which is the product, divided by summation W, which is the total of weights, and total of weights nothing but now price, market price. So the average holding period is 4.25 years. That's called as Macaulay's duration. Write down, see if you have any doubts. Okay, let's go further. So we have learned the duration, then volatility. So volatility, what is the formula? Duration by 1 plus YTM. This is also called as modified duration. Duration is 4.25 divided by 1 plus YTM, 1 plus 0.1, 3.865 times. What is the meaning of this? If the YTM changes by 1%, or let's say YTM increase by 1%, then market price will fall by 3.865%. If the market YTM falls by 1%, market price will increase by 3.865. The inverse relationship, the proportionate relationship between the price and YTM is volatility. Of course, if it changes by 4.865 times, it changes faster and therefore it is more volatile. And it is a measure of linear relationship. It is a measure of linear relationship. So what about non-linear relationship you told? Come, wait a minute. First you write down till here. Okay, fine. Now, so if you look at that graph once more, the curvilinear part, and I told you for a smaller moment, like from this point to this point, when you look at the small change, if I calculate the linear relationship or non-linear relationship, both are almost same. So when the change is small, you can't differentiate between linear and non-linear. So this works well. But if the change is slightly bigger, then the linear relationship and the non-linear will diverge. But if you want to calculate that difference also, and that is called as convexity adjustment. Convexity adjustment, C, convexity adjustment means from linear relationship to non-linear relationship, the gap that is calculated by convexity adjustment. If you know a little bit concept of mathematics, differential calculus, I'm not sure to what extent you remember, or if you know, you heard, there's something like first derivative dy by dx. And second derivative, d square y by dx square, second derivative. The first derivative is volatility, the second derivative is convexity. Anyway, institute calculate in one way by doing something. They'll calculate the present value. If it goes 1% up, then 1% down. So then the difference between those two they try to calculate. That is one method. And I follow this one more small method. Let me give the formula, then let me explain. Convexity, don't worry about this formula, looks slightly very difficult and all. I'll explain in very simple words. Please take a look at it. See, convexity, summation wx into x plus 1. See, we already have xw calculated. We have that already. I just have to multiply it by x plus 1. And denominator, you should remember 2 times summation w. See, like this, here also we had summation w, and I have to simply multiply it by 1 plus ytm square. A little bit of your point you ought to remember. Okay, so how did we calculate this number? Let me explain, then you can take it down. Xw column means this column multiplied by x plus 1. So x value plus 1. So 772 multiplied by x is 1. I need x plus 1. So 772 multiplied by 2. That is 1 plus 1. 1404 multiplied by 3. 1915 multiplied by 4. 2322 multiplied by 5. 33862 multiplied by 6. So you get this number, and that will give you the numerator. Denominator, so 227164.6 is the numerator. Denominator 2 times, as it is 2. Summation W, nothing but market price, that is 9431, and 1 plus YTM, 0.1 whole square. So please write this down. This is numerator. 9431 is the denominator. YTM is YTM. 2 times 2 times as it is. If you have any doubts, you can unmute yourself and you can ask doubts, or you can also use the chat option. Okay.
Sir, so we
Yes.
have to interpret it as if Ytm increases by 1%, the convexity is 9.95 times.
The one small change we should do it. This is 9.95 we got it. This is in percentage terms. For a 2% movement, I'll have to multiply it by 0.02 square. That I mean, basically what I've taken 1% upside, 1% downside, and together we have taken 2% movement. So
Okay.
you have to multiply it by 0.02 square. So when you do this, 9.95 into 0.02 square to express in percentage into 100, you get
Mhm.
0.398%. So when the YTM changes, when you want to know the price, you should take whatever the value you get based on the volatility, 3.365 times, you include 0.398 also. In the sense, if it is upward by 1%, you are going to adjust further 0.398%. So you are not going to take only 3.865. You are going to do either 3.865 plus 0.398 or minus 0.398, because you understand the concept. Linear relationship means upside also same, downside also same. Non-linear means upside is different, downside is different. So 3.865 times we take, and then plus 0.398 I do, or minus 0.398 I do, so that whether upside and downside, it will not be equal. So basically, the linear and non-linear relationship, the difference is this 0.398%. If I have to calculate the price using the volatility, convexity, I'll start from volatility 3.665, that is linear, further adjust for, let's say, plus 0.398 to get a more closer answer. The convexity adjustment, you have to write it and say that 0.398% is the adjustment required for calculating the or estimating the price.
So YTM increases by 1%, market price will be 3.865 plus 0.398.
Correct.
And why
3.865 plus 0.398% we should take.
and for decrease minus
Minus,
3.39.
yeah, we should do either plus on one side and minus on other side.
Okay.
Okay, so now we have done with the fourth part of the question. Let's go for what is remaining. So current market price we calculated, present value, Macaulay's duration, weighted average, volatility of the bond, duration by 1 plus YTM, convexity of the bond, that is summation XW into X plus 1 divided by 2 times summation of that 1 plus YTM and XW. Then expected market price, if there is a decrease in YTM by 200 basis points by Macaulay's duration based estimate by intrinsic value method. Now, Macaulay's duration based estimate means based on volatility, and 200 basis points means you should divide by 100, that will give you 2%. So basis points is actually for every, see, percentage is for every 100, basis points is for every 100 of 100, for every 10,000. So whenever you want to convert from basis point to percentage, you simply divide by 100. So 200 basis points, you divide by 100, so you get 2%. So they're asking, if YTM decrease by 2%, what will happen to the market price? First of all, what is happened to mathematical relationship? If YTM decrease, market price should increase. Yes, let's see how much. Let's use uh, volatility 3.865 times. So for 1%, 3.865 times. For 2%, let's calculate. If there is a decrease in YTM by 200 basis points, Macaulay duration based estimate, volatility 3.865, this for 1% change. For 2% change, this will be multiplied by 2. And that percent change, you apply it on the existing market price. Calculate how much it comes to. Okay, so you get 10,160.5. Okay, now second one is actually the correct one, intrinsic value method. What is intrinsic value method? Present value method. Now what is the discounting rate? Existing YTM is 10%. If it increases by 2%, so it becomes 12%. If my discounting rate is 12%, then I should get the answer. So let's try using intrinsic value method. We can just use the annuity factor for coupon and discounting factor for redemption price. Year 1 to 5, every year coupon 850. New discounting rate 10% decrease by 2, so it is 8. And 1 by well 1.08 equals 5 times and then GT. I hope you know how to calculate annuity factor. And last year you calculate discounting factor, don't do GT, you get discounting factor, and the present value is 10,204. You see, the actual 10,160 is calculated using volatility, but 10,204 is the actual correct price. Can you tell me logically why these two numbers are not same? Because 10,160 is calculated using linear relationship, whereas 10,204 is the actual. So what is the difference? That is because of non-linear relationship. And what you can fill, if you want to calculate, you can use the convexity adjustment to fill that number. I'll show you that number also. First you take it down, then I'll tell you if they asked estimation using convexity, what we would have done. I'll do that also. Uh, as of now, you can take down till here because what they've asked, first you get the answer related to that. Okay, I hope you have taken down this one. Now let me tell you how you could have estimated using volatility. I mean convexity. They have not asked, but I'm just doing it for your reference. Estimation using convexity. Okay, now what is the number we got? Convexity as a convexity adjustment as 0.398, right? Okay, this is for 1% change. So what you are going to do, 3.865 we have got it, right? This will be further adjusted with 0.398. 3.865 linear relationship, 3.865 and further 0.398. The question is should I add or should I subtract? Now please tell me this. When the YTM reduce, what will happen to the market price? The market price will increase, right? And therefore here we are going to do plus. So actually when YTM reduces, the convexity adjustment will be on the higher side. So what calculation is going to be? Just inverse relationship. If YTM reduces, this will be plus. So we are going to do 9431.5, or before that, let me do this one. 3.865 percentage, what we have got, uh, plus 0.398. That is the percentage I'm going to take it. 3.865 plus 0.398, 4.263. Okay, just 1 second. Not on 3.865 because 3.865 for 1%. Just 1 second, just small change. I'm sorry. 3.865 into 2. Like this, I do it because this is for 2% change. This convex adjustment, what we calculate for 2% change. So you do 3.865 into 2, then you do plus 0.398. You do the same thing. 3.865 into 2, the same thing you do it, but only thing what you do extra is plus 0.398. Only that calculations you can do it. So 3.865 into 2 plus 0.398. You get 8.128 percentage there. So what is going to be the change then? Existing 9431.5 plus the change on 9431.5, 8.128 percentage. That is the increase. So 9431.5 into 8.128 by 100, you get 766.59 plus 9431.5, 10,198, approximately 10,200 you get. You see, this number is even more closer now. If you take more decimals, the answer will be more closer. So hope you're able to understand how the convexity bridge the gap between linear and non-linear. Anyway, I'll also show you what institute solution is in this case so that you get that clarity. If you follow the institute method, what you would have got. Just want to show you the institute solution also. So please make sure you have written till here. Okay, I hope it is done. Okay, very good. I'll just quickly go through institute solution, how they have got the answer. Convexity especially, they have used this one, C into dy square into 100. Sometimes you might get confused about this formula. What they have done is, existing is 10%. If it increases by 2%, if it decreases by 2%, what is the price? And between those two prices, they are trying to interpolate. See, they've got 0.395 and we have got same 9 point something only we got, right, in our answer also. 9.95 something we got. That decimal small change will come. That's, you don't worry. But overall answer is 0.395. They have got 0.398. We have got it. So overall answer is fine. Just want to tell you that what method institute has followed. 10% YTM. They have taken 2% upside, 2% downside, and interpolate between these two what is the rate of change. But we have calculated using the same table. Answer ultimately, you see, it's approximately same. So our method is absolutely fine. Okay, this is about the basics of calculations of the bond valuation, different concepts in one simple problem. Okay, let's go further. Let us take this problem on portfolio management. Question number one. Question number on portfolio management, whatever the question number. Ramesh has identified the stock of two companies, A and B, having good investment potential. Following data is available for these stocks. Year, stock A, stock B. You are required to calculate risk and return by investing in stock A and stock B. Risk and return by investing in portfolio of these stocks. If you invest in stock A and B in proportion of 6:4, and better opportunity for investment. So this problem we talk about individual stock A separately, B separately, then we are going to mix them. So how do we calculate the return? We will calculate based on the price for each year. P1 minus P0 by P0 into 100. 18.75 minus 19.6 divided by 19.6 into 100. Think first year you get negative number for A. So let's calculate individual years returns. Just give me 1 minute. Okay, fine. So let's calculate one by one. So first year it is 18.75 minus 19.6 divided by 19.6 into hundreds. So can you calculate the first year return for me? So I'm sorry. So I think I just saw the one chat option now on chat thing. Systematic risk and systematic risk. Do you have that doubt? Should I explain it once more? Okay, fine. That's okay. Let us come to this problem. Then, so how much you get for the first year? 18.75 minus 19.6 divided by 19.6 into 100. Hope you get minus 4.33. Yeah, you get minus 4.3334 if you round it up. Similarly, say next year, how do I do it? 33.42 minus 18.75 divided by 18.75. Every year the P0 will change. So 33.42 minus 18.75 divided by 18.75 into 100. How much that? That also you calculate, tell me. I hope you get 78.24%. So you got that, right? So that's what I'm going to do for others also. So let's not spend time in calculating everything. I hope you got the concept. Let us go towards calculation. And similarly, I'll do for Y, but before that, let me take an average return. Average return means add all these numbers, divide by number of observations. So total is 83.95. 1, 2, 3, 4, 5, 6. 6 years. So divide by 6. That is the average return. Similarly, I'll do for the stock B. Similarly, I've calculated P1 minus P0 by P0 into 100. Again, I get average 16.19. Give me 1 minute. Let me explain about standard deviation also. Then I'll give the time for you to take it down. So please give me 2 more minutes. So when I talk about standard deviation of X, we need summation X minus X bar the whole square divided by N square root. If I don't do the square root, that's called as variance. If I do the square root, that's standard deviation. So what do I need? X minus X bar, the whole square. So first of all, I need X minus X bar. So I'll put that column. What is X? Minus 4.34. X bar, 13.99. So minus 4 minus 13. You get minus 18.33. Then X minus X bar, 78.24 minus 13.99. X is 78 minus 13. In other way, logically, in X minus X bar, you're trying to tell, am I above the average or am I below the average? So average is 13.99, 14 you can say. Minus 4.34 below the average. How much below? 18% below the average. 78.24, it is above the average. So how much above the average? 64.25. Conceptually you are getting above the average, below the average, represented by X minus X bar. You see 3.12 as compared to 13.99, you're below the average, so minus 3.12 minus 13, so 10 point something. Below the average, so it is minus logically. And for your reference, the total of this X minus X bar should be 0. Anyway, then we are going to do a square. 18.33 square, all minus number also becomes plus. So square this number and do the total. Similarly, I'm going to do for y also. Y minus y bar, that is y is 47. Y bar is 16.19. Give me 1 second. Okay, so y is the 47.17 and y bar is 16.19. So 47 minus 16.19. So above the average, definitely. So positive number. And how much? 30.94. X, y minus y bar. Like that you do for others. Then y minus y bar whole square. So 30.94 square, 957. Like that I do the total. And using that, I can get the standard deviation. So standard deviation of x minus x bar whole square, 62 to 6.69, divided by n, number of observation is 6, you get 32.21. What is the logical understanding, my dear friends? Please pay attention to this point. Based on historical data, the stock X is likely to give me 13.44 return. It can be plus, it can be minus. How much? 32.21. So X bar plus or minus standard deviation is the range when you look at a possible return for a stock. I'll repeat once more. Stock X likely to give me 13.99% plus or minus 32%. So plus or minus gives me the range on the upper side and lower side. If the number is higher, the range is higher, the stock is more riskier. Higher the standard deviation, higher the risk. Same thing for stock Y. Y minus Y bar whole square divided by n number of observations, 624.43. Now, between these two stocks, if I compare on risk and return, so we have, I think this is stock A and stock B, right? Yeah, stock A and stock B. Okay, now stock A and stock B, return point of view, if I compare, stock A is giving me average return of 13.99. Stock B is given me average return of 16.19. Obviously, which is giving me higher return? And the higher return is stock B, right? Stock B is giving me higher return. What about risk point of view? Risk means I'm going to use standard deviation. Stock A is giving me standard deviation of 32.21 and stock B is given me 24.43. So risk point of view, whichever is less, and that is also stock B. Return wise also stock B is higher. Risk wise also stock B is lesser. So stock B is good in both the angles. We can say stock B is efficient and stock A is inefficient. Anyway, I just told you for your reference. One second. Yeah, good. So requirement of the question, the risk and return by investing in stock A and B, yes, we have identified. The risk what we get and return what we get. Risk is the average return. Sorry, return is the average return. Risk is the standard deviation. Anyway, so please write down till here, or even if you take a screenshot and later you copy it down, that's also fine. But I would recommend take 2-3 minutes, calculate slowly, and write down. Any doubts conceptually? How do we calculate the returns? Then the deviation, then the square of deviation, and we calculate standard deviation and variance. So for stock returns, we calculate average returns. For the risk, we are going to calculate standard deviation. Okay, I think you can take a screenshot and copy it down so that we can save some time. So we can put more effort on now your more worried areas like derivatives and foreign exchange. Yes. So let me complete the solution. Then you can take a screenshot and you can write it down. I mean, you can copy it down later. And anyway, these are all RTP solutions. You'll get the solution there also, but presentation is slightly different. Let's you can follow this one. It's more simple and structured. Anyway, so what we got now is individual stocks, but we also need to combine. And when we need to combine, we need one more parameter called as correlation, or we can also understand it as covariance. And covariance can be calculated by x minus, okay, let me, portfolio return is simple. They said in the ratio of 6 is to 4 weights. So 13.99, weight is 6 by 10.6. Then 16.419, weight is 4 by 10.4. Returns multiplied by the weights. That is simple. Average return you get. Now let us focus on portfolio risk. For that, I need covariance. And covariance, I mean correlation formula is covariance divided by standard deviation of x into standard deviation of y. And what is covariance? The covariance is product of deviation. X minus x bar is comparison with x. Y minus y bar is the comparison with y. But how they behave with each other? Multiply both. So summation x minus x bar into y minus y bar divided by n. So x minus x bar, we have minus 18.33. Y minus y bar 30.94, multiply both. That is minus 567.13. One is minus, that is plus. Basically means they're moving in opposite direction in this year. Minus into plus is minus, so minus. 64.25 into 10.34, you get 666.27. Like that, you do the total. That is this numerator summation x minus x bar into y minus y bar. So numerator we got 96.37, denominator number of years, which is 6, minus the importance is it is negatively correlated security. And correlation correlation if I calculate, or actually you have a formula where I can compute directly also, but let me do correlation, that is covariance divided by standard deviation of x into standard deviation of y. Covariance is minus 16.06 divided by standard deviation. One is 32.21 and another 24. I don't have space to write decimal, so I'll just write 24. But I hope you get the same answer. So 16 divided by 32.21 and divided by 24.43. You get minus 0.02, I think. Please confirm and tell me, is my calculation correct? 16 divided by 32.21 divided by 24. Minus 0.02, right? Minus 0.02. So negative means the stocks are likely to move in opposite direction. Okay, portfolio risk. Okay, now we have security A and security B. We are mixing. So we need correlation, which we calculated. And this formula is very similar if you can apply A square B square 2AB formula. A square, standard deviation of x, weight of x square. Standard deviation of x square, weight of x square. Plus standard deviation of y square, weight of y square, a square b square, plus 2ab plus 2 into standard deviation of x, weight of x, this is like a, standard deviation of y, weight of y, it's like 2ab, and one more factor will come, and that is r between x and y. and then you take a square root. A square, b square, 2ab, and r also will come. And in fact, what you can do is instead of writing standard deviation of x, standard deviation of y, and r, that is going to give you covariance. So one step you can save. You understand, right? Cross multiply r into standard deviation of y. You understand? You get same thing as covariance. So these three things instead of writing, you can save some time by writing it as r. Anyway, that is just for reference. Okay. Now let me substitute the numbers. Standard deviation of x, 32.21 square. Weight is the 60%, 40%. So 0.6 whole square plus sigma y, that is 24.43 square, and weight in y, that is zero point 0.4 square plus 2ab, 2 into standard deviation 32.21, weight 0.6, standard deviation 24.43, weight 0.4, and multiplied by correlation, so minus 0.02, and you take a square root. This, if you simplify, you can use m plus in the calculator function, and last one should be m minus because minus is there, and mrs is square root. I'll just give the number directly. You can verify that number later. Just give me 1 second. Yeah, approximately you'll get it as 0.21 or I think 21.48 something you get. Yeah, 21.48 you get. Okay, the only point I would like you to observe is this. What is stock X return? 13.99. Stock Y return 16.19, one lower, one higher, and you invest in both, you get average return, you got 14.87 average. Please focus on risk. If you invest in A, 32%, in Y, 24%. If I invest in both, it is reducing 21.48. That is Markowitz. If you add a stock with negatively correlated securities, the portfolio risk will fall. Concept of diversification. Because the variables move in opposite direction, one increase, other decrease, they'll act like a shock absorber. The portfolio will not move on upside also too much, downside also too much. Anyway, so you can just take a screenshot of this, and if you have any doubts in any calculation, it's a time lengthy process, can't tell. So you can take a screenshot and then later you can copy it down. Okay, great. Let's go further. Could you explain? 1 second. Could you explain covariance once? The formula part or the conceptual part? Concept. Okay. Standard deviation is a measure of movement, correct? We have calculated average, but you can get more than average or less than average. So, how much we are deviating from our own average, that is standard deviation. So, what is 32.21 means? We are plus or minus from the average return of x. Then what is y means? The return of y may be plus or minus 24.43 from y average. X compared with x average, y compared with y average. But we want to know how they behave with each other when x changes. The deviation of x minus x bar. In that case, how the y will change? X deviation compared with y deviation. X deviation is x minus x bar and y deviation is y minus y bar, and we multiply, so we get the behavior of them going together. Hope you understand. So there is husband, they have certain priorities. There is wife, they have certain priorities. But if they married together, two people coming together, how they behave with each other for a given point. So, like look at first here, x is negative, y is positive. That means basically they are in opposite direction. Look at last year, x is positive, y is negative, and look at this year, x is also positive, y is also positive. Hope you understood. The concept of covariance tries to measure the behavior between the two deviations. It's an average of product of deviations. Anyway, so it is covariance, and that is expressing in rupee terms. And for us to get a ratio, we go with correlation. So covariance numerator, which is the product of deviation, and denominator, the two standard deviation. If I take a ratio between the two, that will give me the movement in ratio terms, number of times. Okay, good. So let's go further. Next problem. This one is actually not a portfolio problem as such, but it helps in remembering some concepts. And this problem is asked in the again RTP as a part of portfolio chapter. So let's do it anyways. Some concepts also we can revise. Following information is available in respect of expected dividend, market price, and market condition after 1 year. So compare from today. If the market condition is good, the market price can be as high as 115. If the market condition is bad, it can be low as 97, and their chances, possibilities are given as probabilities. The existing market price of the share is 106, which is come 10% debentures of 6 per share. Come means it's including. The value of equity share is having like a warrant where ability to purchase debenture of 6 rupees. So when you want to analyze, you cannot analyze including debenture. So ideally you should take it out. X Finance Limited had offered the buyback of debenture at face value. So actually what is attributable to equity share from 106, take out the debenture component, purely the variability component, equity share component is 100 rupees. Find out the expected return and the variability of return of the shares if the buyback is accepted by investor. Also advise whether to accept the buyback offer. Okay. Let's go with the straightforward calculation. We need to calculate the expected return. So return will be one column and probability will be another column. So let's calculate the return, which is X column, and probability, then that is the P column. When we need average, we are going to multiply X into P. And we also need to calculate the variability, means we need to calculate standard deviation. And for that purpose, you know what and all we require? So we'll calculate X minus X bar, then X minus X bar the whole square. And this is not sufficient. When probability is there, I'm going to do X minus X bar whole square multiplied by probability. These are the columns required for analyzing the returns. Okay. So what is the return in the first case? If it is good, market price is 115. This is taken as P1 and current market price is 106. But in 106, there is debenture of face value of 6 rupees if you go for buyback, meaning debenture component is received, you take out the debenture component. So actual value will be only related to equity share is 100 rupees. So market price after 1 year is 115 minus current price is 100 divided by 100. You also take dividend into consideration, which is 9 rupees, and to express in percentage, you multiply it by 100. So 115 minus 100 plus 9 divided by 100 into 100. Actually, current price also 100. So if you calculate that directly, will give you the percentage. Anyway, so I think you are getting 24. Second case, it is 107 minus 100 plus dividend of 5 rupees divided by 100 into 100. I think you get 12. And last one, 97. So 100 minus, sorry, 97 minus 100 plus 3 rupee dividend divided by 100 to express in percentage into 100, you get 0. Probability 0.25, 0.5, 0.25. Multiply 24 into 0.25, I think is 6. 12 into 0.5 is also 6. This is 0. So expected returns is 12. Average return, expected return is 12. X bar, or some people say expected return. Both are same. Average is same as expected return. X minus X bar. Now X is 24 minus 12. So 12, 12 minus 12, 0, and 0 minus 12 minus 12. We need square. 12 square 144, 0 square 0, 12 square 144. I need to multiply by probability. So 144 into 0.25, 36. This is anyway 0. Then 144 into 0.25, this is also 36. So 36 plus 36, that is 72. So standard deviation is square root of summation x minus x bar whole square, but when you have a probability, multiplied by probability, which you already calculated as 72. So square root of 72, the variability 8.485, 8.49. So what is the interpretation of this? The stock is likely to be around 12% return. It can be plus or minus 8.49. Okay. Now they've also asked, they also advise whether to accept the buyback offer or not. Again, that's a subjective decision. But anyway, let's quickly understand. What is the rate of return you expect from the debenture? Rate of return, what you're expecting is they say 10% from the debenture value. If you go for a redemption immediately, indirectly you get 10% return. I mean, if you redeem immediately, you get the face value. Okay. If you don't redeem, then what do you get? You get 10% return at the end of year one. Now, is the 10% sufficient return? That depends, right? See, if you imagine that 6 rupees what you have redeemed, I mean, you have gone for buyback, and that 6 rupees you invest in this stock, you get 12% return, expected return. But if you don't buy back, you get 10%, that is lesser than. So it's better you do buyback and you reinvest. But if you believe that variability is high, uncertainty is high, you want more of a fixed return, then buyback offer, you don't do it, you remain invested in debenture only. Okay, just write that in sentences so that it's slightly more clear than the sentence what I've used. Okay, so just write down. Okay, I'll explain once more, no problem. Presently, what you have done. Debenture include, I mean, this equity includes 6 rupee debenture and you have redeemed it. That means you received a cash of 6 rupee. And what you do with that cash? The only comparison is equity here. So if you reinvested equity on whatever the amount you invest in percentage terms, you can expect from this stock 12% per annum. If you don't accept the buyback, then on the debenture, how much return you get? 10% is return. That's what the coupon rate. When nothing is specified, coupon and YTM both are same. So if I go for buyback and invest in equity, 12% is beneficial. I mean, 12% return you're getting. If I don't do buyback, I hold the debenture, then I get 10% return. So buyback is beneficial. That is, you do a buyback and invest in equity, you get 12%. But that depends on circumstances, right? 12% is expected one. If you are okay with uncertainty, you go for it. But if you don't want uncertainty, then you invest in debenture only at 10% is more certain. So the decision is more dependent on the risk preference of the investor and market condition rather than the numerical numbers as it is. So just write the sentence. Decision on buyback. Decision on buyback should depend on decision buyback should depend on market conditions and risk preference. Market conditions and risk preference. I hope that you understand. Remaining you extend it. Means if risk preference is to be less, no, I don't want to take risk, go with debenture. Don't do buyback. Don't accept the redemption immediately. Remain invest in debenture. If you okay to take risk, do buyback. Put that money in equity. I hope you got it. Let's go further. Right. Messrs. Corpus, not Copper. Messrs. Corpus AMC on 1/4/2015 has floated two schemes, dividend plan and bonus plans. Mr. X, an investor, has invested in both the schemes. The following details, except the issue price, are available. So, date is there, transaction, date of transaction, dividend percentage, bonus ratio, NAV, dividend plan, and bonus plan. What is a dividend plan? In a mutual fund, one of the varieties dividend plan where they pay out in cash periodically. Bonus plan means they issue free units periodically. So for a dividend plan, this dividend percentage column is applicable. A bonus ratio, the bonus plan NAV is applicable. And dividend is given in percentages because it is always applied on face value. Dividend percentage is always applied on face value. Whereas if they tell you dividend yield, then it is applied on market price. But when they just told you dividend percentage, it is on face value. Bonus ratio 1:4. They also give explanation. 1 unit for every 4 units held. First number represents how many units are issued, and second number represent for having for so many units. If you have 4 units, you get one bonus. Okay, this is a regular thing, but issue price only not given. Additional details, investment 9 lakh 20 and 10 lakh in the both the plans, and the average profit 27,748.6 and average yield 6.4. You are required to calculate issue price of both the schemes on 1/4/2015. So if you start with some investment, I will know the NAV on the date of issue price and I know number of units. Then I can calculate what is the dividend I receive, add additional units I get, or bonus means additional units I get, and what is the value at the end of the year. And simple formula I can calculate for profit, P1 minus P0 by P0 into 100, that is NAV end minus NAV beginning by NAV beginning. Regular formula, you get the annual returns, then annualize it by proportionately calculating for the period of holding. That's a normal question. But institute asks questions like this in exam, reverse questions. Institute is always like that, can't help. So let's try to understand how the calculation works and how to calculate in a reverse manner. Okay, so let's first focus on the dividend plan and then I'll go for bonus ratio. Okay, let me first focus on dividend plan. Okay, how the sequence have turned out, try to follow it. Okay, they have given the date. So let me also write the date and how much amount you have invested, that they have given. Okay, how much amount invested they have given, and what is the first transaction will happen. In the first case, of course, we're talking about the dividend plan. Please, I mean, first one is dividend plan. That alignment issue is there. I think in the problem it should be correctly given, right? 9,20,000 is dividend plan. So 9,20,000 is the amount invested, and by investing 9,20,000, you would have got certain number of units. Correct? You would have got certain number of units. How much units we don't know. Some number of units you would have got. And what is the next transaction will happen? Focus on dividend plan. On 31st of March, you will receive dividend. And what is the regular assumption? You receive the money and you don't keep it with you. You will reinvest. In the sense, you will get the dividend amount on that day, whatever is the NAV, like in this case 48, you will reinvest and you get additional number of units. So what are the columns? Let us put it. First is date, then let us write the dividend receipt, right, in amount, repeat terms. Then this dividend, what will happen? This is going to be reinvested and therefore you get the number of units received. This dividend amount, what you receive, will be reinvested. That is a regular assumption, at least from exam point of view. And then whatever is the total number of units. So let us start with the first date. The date is 31st, 1st of April 2015. How much total number of units? We don't know. I mean, we don't know because issue price I don't know. Then the next date will be 31st March 2017. Since I don't know how many units, I don't know how much dividend received. I'm just writing the dates. Next 31st March 18, 31st March 18. Again, I don't know how many units were there, so I don't know how much received amount is there. Then 31st March 2019. Again, I received the 1 second. Okay. Okay. 31st March 2019. Again, I have received the dividend and have reinvested and I don't know the amount. Then on 31st March 2020, they have given the NAV is 49. And please observe, you made an average profit of 27,748. How much you invested? 9,20,000. So can I say total investment value at the end on 31st March 2020 would be 9,20,000 plus 27,748? Can I say that? What do you think? Can I say 9,20,000 plus 27,748 is the total value, investment plus profit? Sorry, there's one small issue there. What is that? The issue is this is not going. The issue is this is annual, my dear friends, average profit. This is not the total profit, annual profit. I should multiply it by the holding period. So 1/4/2015 till 31st March 2020, that is 16, 17, 18, 19, 20. 5 years holding period. Just 1 second. I'll just write once more. Something is misbehaving. Okay, let me just write that once more. uh, dividend plan, date, dividend receipt, then additional units, then units at the end. Units at the end, cumulative units. 1,415, then 31,317, 31,318, then 31,319. Okay, so these are the dividend received dates. And after this, what is the investment value at year end? Investment value as on 31/3/2020. They have given the NAV on that date, 31/3/2020. That is investment value plus profit. Investment value is 9,20,000. Profit is 27,748.6. This is for 1 year, and we have to calculate how much for 5 years. So if I calculate 27,748.6 into 5, 5 or 4, 15, 25 years into 5 plus 9,20,000. 1058 743. 1058 743. Okay, so this is the investment value at the year end. And what is the NAV as on this date? NAV as on this date, dividend plan 49. Now, I know the investment value on 31st of March 2020. We know the NAV on 31st March 2020. So we can calculate number of units. So number of units is 10,58,743 divided by 49. I think you get 21,607. 21,607. So, number of units at the year end on 31st March 2019, we can definitely say it is 21,607. So like this, now we are going to work backwards, how much dividend you would have received, and you keep subtracting, then you get to know units at the beginning and amount of investment, amount of investment divided by number of units, you will get the issue price. They've included the profit for 2020. Yes, they have included the profit for 2020, and 2020 you have not received any dividends. So for the holding period of 5 years, the profit is added, you get the investment value. So number of units you get it as on 31st March 2020, and you have not received anything in 2020, right? No units. So the same thing is there on 19 also, same units. Got it? Okay, great. Okay. But in this problem, there is one issue, my dear friends. That is, they have given dividend percentage is 12%, but dividend percentage is applied on what number? On face value. But what is face value in this problem? Not given. So without calculating the face value, without knowing face value, how do I know how much dividend received? If I at least know how much dividend received, then I can arrive at number of units by knowing the closing value. So in this problem, we don't have any choice but to assume. Sometimes institute will do like this, and that is why they write at the beginning, make appropriate assumptions wherever necessary. Sometimes they miss out like this. Fate of students, I can't really do anything. So assume face value of rupees 10. If I don't assume this, I cannot move further in the problem. Okay, so face value of rupees 10, the dividend is 12%. So I can say that this is 10 rupees, 12% means 1.2 per unit. And then 10% means 1 per unit. And 15% means 1.5 per unit. One second. Just give me 1 minute. System is slightly slow. Just give me 1 minute. Okay. Now, how do we calculate the number of units here? So look at the information on 31st March 2019. We know the number of units at the year end. I mean, after issuing bonus, it is 21,607. So let's assume you had X number of units before this. So if you assume X number of units before this, then how many units you would have issued, or how much amount of dividend you would have received. So we need to calculate one small simultaneous equation for this. So, I mean, no, small, I mean, we have to assume x and we have to solve it. This is what I was telling. Mutual funds are actually conceptually easy. They make this missing information problem and thereby they will confuse you. Okay, let me solve it. Let me try the description. So how do you calculate the units at the year end or units at the end? Units at the end is calculated as you have existing units plus additional units. Correct? Now existing units, okay. So existing units is, let's assume it as X. And how do we calculate the additional units? Additional units is whatever the dividend received divided by NAV on that date. Correct? And how much dividend you receive? That is calculated as how much ever number of units you have multiplied by dividend per unit. So additional units will be you had X units and you multiplied by whatever is the dividend per unit divided by NAV. Little bit of mathematical equation we are going to solve. So please look at this, see if you are able to understand. If you have any doubts, let me know. Units at the end is calculated as existing units plus additional units. And existing units, I will assume it as X. And additional units is calculated as how much ever dividend received is reinvested divided by NAV on that date. And existing units I have taken as X, and additional units is going to be dividend received, which is number of units into dividend per unit. Therefore, existing is X and units at the end, in this case, we know it is 21607 and existing I've taken it as X and X multiplied by dividend per unit. So in this case, dividend per unit is 1.5 and divided by NAV on this date, that is dividend plan 45. Then you have to simplify this. So let me cross multiply. So 21607 equals X into 45, 45X plus 1.5 into X, 1.5X divided by 45. Cross multiply 21607 into 45, 9,72,315. This is equals 45x plus 1.5x. This is 46.5. X equals 9,72,315 divided by 46.5. 46.15, huh? 46.5, yeah. 20,910. Okay, so 21,607 is the units at the year end. 20,910 is at the beginning. Therefore, units issued will be 21,607 minus 20,910. 21,607 minus 20,910. The closing minus opening part. 697. So please take a look at this calculation, see if you are able to follow, because remaining per calculations you should do it. I just want to make sure that you understand these calculations clearly. Okay, is it done? Okay, so I'll go back, and therefore additional units as we just calculated here, it is 697. And the previous year number of units is 20,910. Now, similarly, can you tell me what is the additional units on 31st March 18 and 31st March 17? Can you try following the similar method? This is as on 31st March 2019. Can you tell me similarly, if you calculate on 31st March 2018 and 31st March 2017, how many additional units you get? You should get 410 and 500, right? 18 you get 410, and 17 you should get 500. So please see if you are able to get it. Otherwise you write it down and try it later. If you are able to get it, that's great. So this is 20,500, and therefore units at the beginning is 20,000. Therefore, what should be the issue price? Amount of investment is 9,20,000 divided by the number of units 20,000. So you get issue price as rupees 46. Okay, great. Now let's go to the bonus plan. Bonus plan is relatively easy because there you don't have to assume the face value and all, just the ratio. So number of units wise you can go backwards. Let's follow the same approach. Let's do for the bonus plan. So bonus plan, the same approach. Let's do date. You want to show the working, you mean the number of units calculation, or this dividend received in additional units slide. Is this slide fine? Yeah, okay, fine. Done? Okay. So bonus plan, same format I'll follow. Date, number of, that is, then whatever the bonus ratio, their dividend received, here bonus ratio. So additional units, then units at the end, same format. Okay, so date of bonus issue, we have two dates, 31st December, starting with 1/4/15, 1/4/15. Then 31st March 17 is, sorry, 31st December 16, 1:4. 31st December 16, 1:4. Then 31st December 18, 1:5. And investment on 31st March 2020, I mean, the investment value we know, plus we can calculate the profit and average yield they have given. So we'll have to apply it on percentage terms and multiply it by the number of years. So let's calculate investment value as on 31st of March 2020, that is investment plus profit. The investment what is made is 10 lakh, profit is 6.4, but 6.4 percentage, so per annum. So what do we do? 10 lakh multiplied by 6.4 percentage for number of years. Number of year is 5 years. So if you simplify, 10 lakh into 6.4% into 5 plus 10 lakh. So you get 13,20,000. And NAV as on this date, bonus plan 44. The number of units is 13,20,000 by 44. 30,000 units. So 30,000 units is the closing. And additional units, it's fairly simple to calculate. No need to assume anything. See, 1:5 is the ratio. So if you have 5, you get 1. And after getting, what is your total? That is 6. So this 30,000 represent 6 units. And how much for 1? So that will give you 5,000. I'll repeat this discussion once more. 1:5 means if you have 5, you get 1 and totally it becomes 6. So this 30,000 represents 6. So 30,000 divided by 6, 30,000 represents 6, and how much for 1? So into 1 by 6. So 5,000, and therefore units at the beginning should be 30 minus 5, which is 25,000. You can also do 25,000 into 1 by 5, you get 5,000 verification, or 30,000 into 5 by 6, you get 25,000. 1:4, if you have 1, if you have 4, you get 1, so totally 5. So 1 by 5 into 25,000 into 1 by 5, this is again 5,000. So 25 minus 5, units at the beginning is 20,000. So issue price Amount of investment made 10 lakh divided by the number of units 20,000. So you get 50 rupees. Okay, so this is about the reverse NAV calculation of issue price. Okay, I hope it is done. Let's go further. Okay, let's go further. A 2-year share of a stock in ABC Limited is as follows: 100 N1, 102 N2, 95 N3, then 1116.64, 102.6, 90.25. Consider 2-year American call option of one stock of ABC Limited, strike price of 98, current price of 100, risk-free return of 5% with a continuous compounding. And whenever they say continuous compounding, they are obliged to give you E power, which they have given, E value. Assume two-period binomial model of 1 year each. Using binomial model, calculate the probability of price moving up and down, expected payoff at each nodes, that is N1, N2, N3. That's all. Okay, that means N1 means I have to compute the value of call option. Okay. So what was binomial model? If you remember, you have a starting point. Either it can go up or it can come down. Only two possibilities, and that's why we called as binomial model. Now, two-period binomial model means that whatever we have discussed in binomial model, right, we divided into two more parts, two sub periods. If the contract was 6 months, we divide this into 3 months and 3 months. If the contract was for 1 year, we divide this into 6 months and 6 months. In this case, the contract is 2 year. So we have divided into 1 year and 1 year. And what they've given the price. See, 100 become 108. That means 8% increase. 100 becoming 95 means 5% decrease. 195 means 5% down. 108 to 160 means again same thing will apply. 8% increase. You can cross check. 108, 8% increase. Is it 116?
చల్లగా కాలే అదే చాలా చూపిస్తాయి
So you get 116.64 only, right? Yeah. So that's what will always happen. But two-period binomial model, the same percentage what is up and down in the first period, same thing is applicable in the second period as well. So 8% up and 5% down. And here 5% down, that is 8% up and 5% down. The same thing is applicable in the first period as well as in the second period. Actually, if you see, there are four possible prices. If I have to call it, as this is as a, let's say price, let's say S1, this will be S1, S2, S3, S4, because 1 becoming 2 and 2 becoming 4, right? It's just that both of them converged, that is 8% up and 5% down, is same as the 5% down and 8% up. So both of them, they have taken it as same, so that converged into the same number, but technically there are four possible numbers. Maybe we better write like that, so we get a better control. Okay, what is going to happen is this. This is the underlying, that price today becoming 2 more and the 2 more becoming 4. What we're going to do, the same thing with respect to options. Same chart we write, 1 becoming 2, 2 becoming 4. Then we calculate these are the prices on expiry date, estimated prices, of course, possible prices on expiry date. This we compare with, let's say we'll calculate the value of a call option, and then we discount it to second period and we come to the first period. So what I'm trying to tell you is prices will go from today to 1 period to 2 period, and option value we calculate on 2 period, we come to 1 period and we come to 0. We use the concept of probability for average for expected value purpose, and we use the concept of present value, that is discounting rate, to get the present value. Let me just quickly show you how it works. And of course we have to calculate the probability also, because if you want to calculate the expected value, you need probability. And what probability you are going to use? Risk neutral probability. Okay, let me give you the overall approach, and then you can take it down. So we are going to solve it in, let's say, 3 steps. Step 1 is risk neutral probability. And step 2 is the underlying, or the price of the stock, underlying price, or you can say stock price. In fact, in this case, the stock price, you don't have to worry. They only have given in this question. And then step 3, option valuation. Option valuation. Okay, so stock price will start with today price, then will increase 1 year later and decrease 1 year later, and that price will again further increase and further decrease, this price again further increase and further decrease. And these amount they have given, let me just fill it up. This today price is 100 and 8% up, that's what they said, 108. In some problem they don't give you 108 and they tell it will go up by 8%, or it can come down by 5%, so it has become 105. 108 further 8% up, so it becomes 116.64, or it is down by 5%.
So the 5% down will be 95.
95, yeah, correct. If it is down by 5%, it becomes 95. So 108 down by 5%, as the question only given, 102.6. And 95 it increased by 8%, that also will be same number, 102.6. So as I told you, these two numbers happen to be same, so they are written one time, but for our reference, let's write 2 times. And in some problems, they don't give you this number. By applying the percentage, we arrive at the market price. If it is 5% down, then it is 90.25.
Sir, in this question, it is the percentages are same of up and down in the tube to both the periods. But can it be like it,
No,
it
it
can be
will
different
be no, it will
percentage?
be same in other problem also, because that is a fundamental assumption of two-period binomial model. We take a percentage up and take a percentage down, and that we apply it in both the periods, the first sub period as well as the second sub periods.
Okay.
Yeah, so we got the four prices. Now coming to the option valuation, the same thing I'm going to do it. That is, we will have a value today, which they call it as N1, N2, N3. So we will have a value today, which is divided into two parts, and after 1 year, and after 1 year, and that will be divided into two parts again, and that will have the sub period later value point in time. Okay, now only difference is in option value, I don't move from left to right because I don't know the value today. I move from right to left. In the sense, based on these market prices, I compute the values on the expiry, then I bring it backwards. This will be the approach. Now, before that, let me calculate the risk neutral probability. The formula for risk neutral probability of going up. This P represents probability of going up. R minus D divided by U minus D. Hope you know the full forms. R is representing 1 plus risk-free rate of return. Of course, you have to adjust for time period. Then U is 1 plus percentage up, and D is 1 minus percentage down. Or some people, instead of doing percentage method, they'll directly go for rupee method. That is also fine. But anyway, let's go with this one formula. Too many things we confuse. So risk-free rate of returns, it is 5%. So ideally I should do 1 plus 5.05, right? But they said continuous compounding. So when it is continuous compounding, the formula will become e to the power of Rn. E to the power of Rn. R is rate of interest and N is number of years, term. So in this case, rate of interest is 0.05 and number of years is 1 year. If it was 3-month period, I would have multiplied by 3 by 12. And 5%, I mean, E to the power of 0.05, they have given 1.05127. If it otherwise, I would have taken 1.05. That's it. So 1 plus percentage down, that 8% up. So 1 plus 0.08 is 1.08, and percentage down was 5%. So 1 minus 0.05 is 0.95. So this becomes 1.05127 minus D is 0.95 divided by 1.08 minus 0.95. Okay, simplify this and see how much you get. Uh, 1.05127 minus 0.95 is 0.10127. 0.08 minus 0.95, 0.13. So this divided by 0.13 is 0.7789. Let me take two decimals. I mean, you can take three decimals also, just for quick calculation. I'll take two decimal 0.78. So what is basically that 0.78 means? Probability of going up in each period. We have taken 8%, 5% for one sub period, and it's for same thing for second sub period. So this is a probability of going up 0.78 for each sub period, and probability of coming down is 1 minus 0.78, which is 0.22. Same thing for second sub period. Probability of going up is 0.78, coming down is 0.22, going up is 0.78, coming down is 0.22. And this they have called as the N1, N2, N3. So let's also use the same notation. This is N1, this is N2, and this is N3. Or yeah. So you can also write the values once I compute N3. Or I'll just write it outside. N1, N2, N3. Okay, now for you to come to N1, N2, N3, I have to start with the expiry date first. So what is the value here and here and this price and also at this price? Value of call option. Now, what will be the value here? That is strike price. What is the strike price? The call option strike price of 98. So when it is 98, what will be the call option? When market price is 116, market price is high, call option exercised. So 116.64 minus 98. 18.64. And similarly, 102.6 minus 98, 4.6. This also 4.6. Why we subtract? We are calculating the value of intrinsic value of call option. So what is the concept of binomial model? We have possible prices. From the possible prices, we calculate the intrinsic value, market price minus strike price. I'm not sure if you're able to follow it. When you want to calculate the value of call option on expiry date, that is intrinsic value, is difference between market price and strike price. I hope you could connect the basic concepts of call option. You got it? Market price is 116, strike price 98, which basically means if I buy at 19, go to market, I get so much of benefit, which is called as intrinsic value. And what is the process we follow in binomial model? We calculate that intrinsic value. We will get two intrinsic value if you take one time at a time, one period at a time. So that two intrinsic value, you multiply it by respective probabilities and sum it up. And that will give you expected intrinsic value. And that you bring it down, and that will become the value as on date. That's the process. I'm going to apply it now. If the market price is 116.64, this 116.64 is the expected market price. If the price is 116, the value of call option, that is intrinsic value, at that point would be 18.64. Similarly, if the market price is 102.6, it would be 4.6. That is 102.6 minus strike price 98. And what will happen if it is 90.25? Can you tell me? If the market price is 90.25, option will not be exercised. Call option not exercised when the market price is less. So intrinsic value cannot become negative. Intrinsic value is always zero. The holder will have the right. We always calculate from holder point of view. Okay, so now we got this intrinsic value. Now, how are we going to calculate this N2, N3 is by expected value what we get. Now, what is the probability of 18.64? It is 0.78. What is the probability of 4.6? It is 0.22. So, how do we calculate the expected value? The number multiplied by respective probability. That will give you the expected value, and you have to bring it down by one period. So, you apply the present value. So what formula we are going to calculate for N2? Let me write it here. This is this nodal point. N2 is calculated as what is the number at the end of the period? It can be 18.64 and its probability is 0.78, and it can be 4.6 and its probability is 0.22, and then we bring it down. We have to apply the present value, and the present value is, we know this number. Let's take use of this 1.05127. Last year 98.5, I think is not considered because I get 98. Not 98, I think 90.25, my dear friend, not 98. I think you're talking about this number 90.25. This last number you meant, right? 90.25, not 98. Maybe my handwriting looks like that. Is 90. When market price is less, the option is not exercised. I know you can think like strike price is more, but let's keep it very standard one. When the market price is more, call option exercised, the difference becomes the intrinsic value. When the market price is less, in that case, the option becomes not valuable, so therefore option will lapse, the intrinsic value becomes 0. Okay, now let me explain this calculation once more. What I did here, 18.64 or 4.6, one of them can happen in one situation. 18.64, its probability is 0.78. 4.6, its probability is 0.22. So multiply both and add, you get the expected value. And that number, you bring it one term less by applying present value factor. Similarly, let me write it for N3 also. What process we are going to do? 4.6 probability is 0.78. 0 probability is 0.22. So 4.6 into 0.78, 0 into 0.22, multiply, sum it up and bring it down. You get the value of N3. That you try. First, you tell me what is the value of N2 coming to. If I take just two decimal, 14.79. Hope everybody is getting it. 14.79. And this you try. Similarly, 4.6 into 0.78 plus 0 into 0.22. Again, you divide to the today's value, that is present value 1.05127. Hopefully you are getting 3.41. So they've asked those two things, we have calculated 14.79 and 3.41. So what we have done, please observe, this intrinsic value what we calculated, 18.64, 4.6, 4.60, these are all the possible prices at the end of second year on expiry. Now we have brought it one term back. At the end of first year, the value of option can be 14.79 or 3.41. Now we need the value today. So apply the same process and calculate the value as on date, and that is 14.79. Its probability is 0.78, 3.41. Its probability is 0.22, and then discount it by 1 year discounting factor. The present value is N1. So N1 going to be 14.79 into 0.78 plus 3.41 into 0.22 divided by same factor 1.05127. So you get 11.69. That 11.69 is N1, and this is actually called as value of call option. Theoretical value of call option. What is supposed to be the value of option premium? We are discounting for 2 years. Yes, because the term is 2 years only, no? But only thing is we are doing 1 year at a time. Discounting factor is for 2 years, but we are moving one step at a time. From second year, we are coming back to first year, and we apply the present value factor. And for first year, I have come back to 0 year. So for calculating N2, we should consider PV. First year only, no? Everything. Even for N2 or N3, we have to take only one period. All these things calculated one period at a time. Look at this probability 0.78. It is from year 0 to year 1 and year 1 to year 2. Both are 0.78. So one period at a time is this probability. Discounting factor also. One period at a time. So 1.05127 is only 1 year part, sub period. If the problem was for 6 months, you should divide into 3 months, 3 months. Then all these calculations will be for 3 months at a time. All these calculations will be sub period at a time. In this problem, 2 year is the contract period and sub period becomes 1 year, 1 year. So whatever is there, you divide this into two equal parts and you take them separately. And you keep bringing it down one step at a time. Okay. I'll ask you this one small question. See if you can understand. Value of call option today is 11.69. If the question in the examination asks you like this, what is the likely to be the price? What is likely to be the value of option after year 1 if market price turns out to be 108? If they ask you the question like this, what will be your answer? After year 1, if market price turns out to be 108, that is what is N2, no? If market price turns out 108, at this point in time, the value what you got is 14.79. So, value of call option after year 1, if market price 108, the value of call option would be 14.79. And after year 1, if market price turns out to be 95, then the value will be 3.41. Anyway, I just wanted to tell you that comparison if they are asked one step further, but if at all they ask in the exam, it is typical problem what you have solved now, which will come in exam also. Okay, great. Okay, let's go further. The next question, Sham buys 10,000 shares of X Limited at 25 per share, obtains a complete hedge of shorting 400 Nifty at 1100 each, he closes out his position on the closing price of the next day when the share of X Limited has fallen by 4% and Nifty future has dropped by 2.5%. What is the overall profit or loss from this set of transaction? So this is the problem on uh, okay. He obtains a complete hedge, perfect hedge. This is a problem on hedging. What is this hedging concept? Uh, if I usually tell this in a simple words, it means have a backup before breakup. Anyway, hedging means you have shares, and in shares you are worried if the share price falls, there is a loss, and to compensate that you take a position of short. And where? In Nifty. Why? Because Nifty futures are easily traded in the market. So I have one portfolio position, long position, portfolio position, and on portfolio position we are having a long position, and on Nifty futures I take a short position. Why I take a short position? Because the movement happens in opposite direction. If there is a loss, and in short position I get a gain, so compensation happens. But they are not equally riskier. Why? Because portfolio will have a higher beta. Nifty future means market, and market beta is 1. So if you want a complete hedge, you have to multiply the Nifty future with beta, and so that these two things will become comparable. So when you are doing a when you're doing a portfolio hedge, what should be your position in index futures? Okay, or let me do one thing like this. I'll usually present the solution in a tabular format, so easy to follow. So we have like this. We are taking a position today. Uh, he closes the position next day and the next day, later date, and you have a position in spot market. Means basically you have a portfolio, or in this case you have X Limited shares, X Limited shares, and you take a position in futures, that is the Nifty futures. And how much position you are having in spot market? 10,000 shares of 25. So 10,000 shares of 25, which is 2,50,000. And in Nifty futures, I mean, here you are going to take a long position. You are having a long. The Nifty futures, you are going to take a short position. One long, one short, by taking opposite position. But how much? So while taking the Nifty future position, you have to take like the formula goes like this: portfolio value multiplied by beta. And sometime they'll tell you lot size of Nifty futures, because you can't buy one Nifty futures and all. So you'll divide by the lot size so that you get in number of units in the multiple of those lot size. But in this problem, I think we don't have any lot size. Oh, they only have given. He's hedging he hedged a shorting of 400 Nifty. Oh, in this problem we don't have beta also. Okay, but anyway, if I'll just give a formula just for your reference, it might help you some in some other problem. So number of units is calculated by portfolio value multiplied by portfolio amount multiplied by beta of portfolio, divided by whatever is the lot size. lot size Nifty is actually 50 units, like that. It will be traded in multiples of certain number of units and multiplied by the future price. Like Nifty is trading at 18,000 futures, like that. So one unit price multiplied by number of units. So this will give you, I mean, multiplied by lot size. This will give you number of units to be taken. This you don't have to calculate. In this problem, this is given as 400 units. See, hedging 400 Nifty at 1100 each. So given as 400 units at 1100 each. So this you don't have to calculate. In some other problem, you might calculate. Just for understanding purpose, what is the value? Can you tell me indirectly? 400 units at 1100 each means what is the value of transactions? 400 into 1100. 4,40,000. Now please understand, portfolio value is 2,50,000, and if Nifty value 4,40,000, why are you taking additional position? Because portfolio is extra riskier. So beta must be, implied beta you can say, beta must be 4,40,000 divided by 2,50,000. This they have not asked. I'm just computing for your reference. So 4,40,000 by 2,50,000, 1.76. So beta must have been 1.76. In some problem, they might say compute the implied beta or reverse calculation, arrive at it. We might arrive at like this. But anyway, ultimately, what is required is number of units. In this problem, they have given. So let's go beyond that, based on that. Explain the formula once. Okay. Uh, Let me explain the numerator. I'll explain the denominator. Focusing on numerator. Using the Nifty futures, I am trying to cover the risk of portfolio. But the beta of the Nifty futures and beta of the portfolio are not same. The risk is not same. And how you measure the risk? With the help of beta. So if you want to equate the risk of portfolio, the amount of exposure should be portfolio amount multiplied by beta. That is the risk which Nifty future can compensate. If you take 1 lakh here, 1 lakh here, if the market, if the, let's say stock market, Nifty future falls by 10%, but portfolio falls by 1.1%, like beta is 1.1, if your portfolio will fall by 11%. You understand? You cover only lesser portion. To equate the risk, the position should be portfolio amount multiplied by beta, that is the numerator. The denominator will be value of one contract. Numerator is amount divided by value of one contract. The answer is number of contracts. Why it is? Because practically you cannot enter into 1 unit or 2 units, you have to enter into a lot size. Like for example, Nifty lot size is 50 units and market is trading at, let's say, 20,000. So 50 units into 20,000. That becomes value of one contract. So denominator lot size multiplied by future price. That is the value of one contract. How many units are there? And multiplied by the value of one unit. That's basically value of one contract. So numerator is the position you're trying to take. Denominator is the value of one contract. So number of contracts is calculated using this formula. I hope you're able to follow that formula. And if you have any doubts in any of those, either numerical part or denominator part, you can get that clarified. Okay, very good. Let's come to the next day now. What happened subsequently? Next day, share of X Limited fallen by 4%. So share fell by 4%. So you have taken a long position, and in long position, down means loss. So loss of 2,50,000 into 4%, that is 10,000 loss. And in Nifty future, you would have taken a short position because I told you one long, one short will be there. And therefore, what happened here? Nifty future also dropped, but Nifty future also dropped. Nifty future dropped by 2.5%. But this is not going to be a loss. This is going to be a gain. That is the purpose of hedging. That is the result of going on short position. When you go on short position, you're expecting the price to come down and you're getting a gain. That's the purpose of hedging. I get loss in one, I get profit in another. Ultimately, both should perfectly match. I mean, one should compensate for the another. So gain will be, your position is 4,40,000. What exposure you have taken multiplied by 2.5%. 11,000 gain. So overall, 11,000 minus 10,000, 1,000. Okay, now the question is this. Yes, I was about to answer your question. Is it a perfect hedge? Because if perfect hedge should happen, it should be zero profit, zero loss. The loss should be compensated exactly. Yes. Perfect hedge is a objective, but reality, it need not be. There will always be some plus, some minus. Now, one main reason it happens because the number of units sometimes can be fractional. So if you have 400.23 units, if the answer comes like that, 2.35 contracts. So either you end up taking more position or less position. So because of the round off, you may not be able to achieve perfect thing. And one more thing also, why perfect hedging may not be achieved is because the beta is only an indicative measure. What is likely to happen in a stock, it is not a perfect predictor. Nobody can tell with perfection with respect to the share price. What do you mean by that? Let me tell you. Now, Nifty is down by 2.5%. That is correct. Market, Nifty means market, is down by 2.5%. And implied beta we have calculated as 1.76. What do you mean by 1.76 interpretation? If the market moves by 1%, if market falls by 1%, the stock or the portfolio should fall by 1.76%. So then what should happen? What should have happened to X limited price if beta holds good? If the movement happened exactly based on beta, if beta holds good, then it will be 2.5 market fall multiplied by the share, I mean beta, which is 1.76. So it should have fallen by 4.4 percentage, isn't it? But actually what happened? It has fallen only by 4%. If 4.4% happened, imagine if 4.4% happened, then what you would have done? 2,50,000 into 4.4% loss. How much loss would that be? 2,50,000 into 4.4%, 11,000. You see in that case, 11,000 loss and 11,000 profit. Overall profit would have been zero. perfect it would have been achieved? Ideal. But practically, Nifty is a historical data point. It's an average. Future every day based on beta only it happens? No, that is not the case. See, on an average, you take to travel from your home to office 45 minutes on an average. Does it mean every day you take 45 minutes? Someday it might be 50, someday it might be 40. Beta is also like that. It's an indicator of historical average. So, but on any given day, it might be a little bit more, it might be a little bit less also. So that is why perfect hedge may not be achieved in reality. But when you're trying to calculate the formula, yes. And if actual fall is not given in the problem, actually how much fall the stock has fallen not given, then what do we do in exam? Let's assume beta holds good and we calculate that price is fallen by 4.5%. So in the examination, if stock fall is not given, then using beta, we'll try to estimate, and there definitely we can achieve a zero profit, zero loss situation. Okay, so this is the problem on hedging, perfect hedging, where you're trying to cover fully. In some problem, you know what they tell you? You take beta 1.76, but we don't want to cover that fully. I want to cover only 1.5, balance 0.26. I will keep it unhedged, partial hedging. Then I will not multiply it by 1.76, I'll multiply it by 1.5. In the sense, how much risk you want to reduce, that much you multiply. You are able to get the point? I have a risk of 1.76. I want to reduce by 1.5. Yes, you multiply it by 1.5. The result is 0.26. Or they also say formula, it is difference between current beta and target beta. Current beta is 1.76, target beta is 0.26. The difference that will be position in Nifty future. How much ever you want to reduce the risk by, focus on my words, how much the risk to be reduced by, that much position is taken in index futures. Here we are having a risk of 1.76, and they're not given, we have calculated indirectly, but if you multiply it by 1.76, that is called as perfect hedge, trying to reduce the complete risk. Okay, so in the exam you don't have to calculate all these things, I just told you for your reference. If I want to reduce it 1.2, you want to reduce by 1.2 or you want to reduce it to 1.2? Reduce to, okay, yes. If you want to reduce to 1.2, so from 1.76, if you want to come to 1.2, yes, that 0.5 something you get, right? Difference. That is the number I should multiply. One more situation I will tell you. What if beta is negative? If beta is, for example, minus 0.5, and I want to do a perfect hedging, I want to make it as 0. If beta is minus 0.5, then I'm not going to take a short position index future. I will take plus 0.5, which means I take long position. What points you forget? I'm just giving minus 1 point, minus 0.5, or anything you can understand. I'll just give an example. If the portfolio beta was minus 0.5 and I have to go to the beta of 0, then I have to take a position of plus 0.5, right? Minus 0.5 to 0 means I should do plus 0.5. Remember like this, plus means long, minus means short. Plus means long, minus means short. What in this example, my present case is plus 1.76. I have to reach 0. So I did minus 1.76 means I have to take a short position of 1.76. If I have to make from 1.76 to 1.2 means I should do minus 0.56. So in index future, I take a short position of 0.56. One more thing I'll tell you, from 1.76, I want to go to 2. I want to increase my risk. That's not hedging, but I want to look at that situation. What do you think we should do in that case? I have to increase by 0.24, right? Plus 0.24. So what position I take in index futures? I take long position. I don't take short position. So for conceptual purpose, you remember like this: plus means long, minus means short. Okay, so hope you got it. Let's go further. Okay, so let us read this problem. XYZ has taken a 6-month loan from the foreign collaborator for US dollar 2 millions. Hope this is the same question you have. XYZ has taken a 6-month loan from foreign collaborator for US dollar 2 million. Interest is payable on maturity at LIBOR plus 1%. The following information is available. Spot rate INR/USD 68.5275 for 6 months, forward rate INR 68.6575. 6 months LIBOR for USD is 2%. 6 months LIBOR for INR is 6%. You're required to calculate the rupee requirement if forward cover is taken. Advise the company on forward cover. What will be the opinion if spot rate is 68.4275? This is, I mean, different types of hedging techniques are there. We have forward hedging, money market hedging, things like that. And this is the problem based on that. But before we go to the problem, I would like to spend few minutes on the concept of interest rate parity theorem. It is understood in different way, and it's also another form is a purchasing power parity theorem. It's basically comparing between two countries or two currencies. Let's say we have foreign and we have local. So what is this purchasing power parity theorem says? The two currency in two countries should give you the same ability to purchase. In other words, if in one country there is inflation of 8%, another country there is inflation of 4%, the difference in the inflation should be the reason the difference in the exchange rate fluctuations. Or the formula wise, they write like this: interest rate parity theorem or purchasing power parity theorem. Interest rate uses, I mean, interest rate parity theorem uses interest rate, purchasing power parity theorem uses inflation rate. The forward rate, theoretical forward rate, theoretical forward rate is calculated using the spot rate into 1 plus local interest divided by 1 plus foreign interest. So basically this is trying to tell you No country should have advantage in borrowing or deposit investing. Means what? In foreign currency, if interest rate is 12%, in India, if interest rate is 15% or local, what the borrower will think now? Instead of borrowing in rupee terms, if I borrow in foreign currency terms, I'll borrow at a cheaper rate of 12%. I save interest. The savings in interest will get compensated because of the dollar appreciation, rupee depreciation. You end up paying more. So what you gain in interest expense, you lose in foreign currency fluctuation. So loss in one will be compensated in another, or otherwise, what this also can be understood as the interest rate differential. Interest rate differential should be equal to the foreign fluctuation. That means forward premium or discount. If not, if for example, if interest rate beneficial, if forward premium is less, that means a foreign currency is not fluctuating so much. It's better you can go for foreign currency. That is, if not hold good, if it does not hold good, then there exists arbitrage. Means one country is favorable for borrowing, another country or currency is favorable for investing. It creates a disparity. Anyway, that is what I just want to cover it quickly. Now, let's understand the requirement of this problem once more. Let us read. XYZ has taken a 6-month loan from foreign collaborator for US dollar 2 million. So you think from XYZ company point of view. So today XYZ has borrowed, has taken a loan, borrowed loan of 2 million, 2 million USD. And it is the 6 months. So 6 months later, XYZ has to repay. And how much? Not just 2 million, 2 million plus interest. It is interest payable on maturity, LIBOR plus 1%, and LIBOR applicable for USD is 2%. So 2 plus 1 becomes 3%. Okay, so 3% you have to pay interest. I mean, whatever the amount comes to. That is for 6 months, you should do it to 6 by 12 and all. So you have to repay 2 million US dollar plus interest. Now, please tell me, what will XYZ do by borrowing $2 million? Why are they doing it? Why are they borrowing it? They need for their project, their for operations, for paying some expenses, investment in some machineries. They need it as a source of finance. So they will exhaust it. They cannot keep the money with them. Otherwise, why will you borrow? You need to borrow for some purpose. So you exhaust it for some projects. Now, after 6 months, when the time comes to repay, you need US dollar. Where and all you can get that US dollar? You can get in the spot market. I mean, you can buy from the spot market, whatever 6 months, not spot market today. spot market. After 6 months, you can buy. You need to buy dollars. Then only you can give it to the your repayment part. But for you to buy, what is the rate? You don't know today. So that is called as unhedged position. That is called as unhedged position. Or you can also do through one more method, and that is called as forward buy. Means whatever is the forward market, forward rate will be known today itself. You enter into a commitment, that's called as forward market hedging. Or you can make use of money market hedging. Money market hedging means you create a situation of deposit and borrowing. You have a borrowing, so you create a deposit today, and accordingly you try to create. I mean, in this problem may not have it, but just for your reference, we'll write it: money market hedging. There are also other mechanism through which you can do it. uh, Option hedging also is possible. If you have a foreign currency US dollar option is available, you can become a call option holder and buy it. Or you can do future hedging. You can enter into a position on future buying. Or there's interest rate swaps. So many options are available. Interest rate swap, anyway, we'll cover it in the interest rate management chapter. So this is the overview. I hope you're able to get the concept. Now, when will I go with money market hedging, and when will I go with forward market? This spot buy is anyway unhedged. Forward market, actual forward rate will be given. Should I do money market hedging or not? For that purpose, uh, we will go with IRPT theorem formula. If I'll calculate IRPT theorem formula. If I see any benefit there, if some currency is more beneficial, or I'll calculate as per IRPT theorem and forward market, and whichever is more beneficial, I can go for it. But anyway, don't worry about it. These are the different alternatives which are possible. I hope you got the overall requirement now. Let's calculate now one by one. Calculate the rupee requirements if forward cover is taken. So it's not about spot buy. They're straight away telling go with forward market. And what is forward market rate? They have given 6 months forward rate is 68.4575. So what and all you're going to pay? 2 million US dollar along with interest. Interest is at the rate of Libor plus 1 and Libor is 2. So 2 plus 1 becomes 3%. So you calculate the interest along with the whatever the principal amount, and that if you hedge today, you enter into a forward contract at 68.4575, that will be the outflow that will take place after 6 months. So let's calculate that part. If forward cover is taken, if forward cover is taken, then how do you calculate it? Whatever is the expected USD outflow after 6 months multiplied by the forward rate quoted today. Okay, expected USD is 2 million plus interest. So 2 million means 6 zeros. Interest of USD 2%, Libor plus 1. So 2 plus 1, 3%. And for a period of 6 months. This is 6 months loan. Multiplied by the forward rate cover. Forward rate is this 68.4575. this is 2 million plus 2 million into 3 by 100 into 6 by 12. 30,000. So 2 million plus 30,000 multiplied by 68.4575. 13 crore 8968. 13 crore 8968 725. Okay, so this is out if the forward cover is taken. This will be rupees 13 crore 89, and this is the expected outflow after 6 months if the forward cover is taken. Okay, second part of the question. Now, what will happen if you don't take the forward cover? Then you have to wait for the market on that day, which is don't know what would happen. That is uncertain. That's called as unhedged. And look at the second part of the question. Advise the company on the forward cover. What will be your opinion if spot rate is, now that is will come later. Advise the company on the forward cover. Means this is the forward cover quoted. What rate? 68.4575. Now, if you don't take the forward rate, if you don't do the forward cover, you have to wait for that day rate. Of course, I don't know what is the day rate. And therefore, based on today, I expect what is likely to be the rate after 6 months. I calculate using IRPT theorem. So, spot rate after 6 months is calculated as theoretical forward rate using IRPT. Spot rate after 6 months is calculated as theoretical forward rate using IRPT, because spot rate on that date after 6 months we will not know now. So we only can think theoretically what is likely to happen. Just explain you the concept of interest rate parity theorem, which means that the currency fluctuations and interest rate differential should be equal. That is the concept, that is theory. So applying that theory, let's see what is going to be the forward rate. So rate using IRPT, spot rate into 1 plus local. In this case, local is in rupee. 1 plus rupee interest divided by 1 plus foreign. Foreign in this case is US dollar. US dollar interest. So spot rate is 68.5275 68.5275 into 1 plus. And what is the rupee interest? Rupee is 6%. Don't do plus 1, na? That plus 1, LIBOR plus 1 is only for the loan taken. For taking the rate calculation, that LIBOR plus 1 and all you don't take. The LIBOR plus 1 is only a contractual arrangement. When you're calculating the forward rate, it is in the market. So you take the market general rate. Rupee interest at 6%, so 0.06. But I should take proportionately for number of months. So this is for 6 months. So multiplied by 6 by 12 divided by 1 plus US dollar is 2% multiplied by 6 by 12. So 68.5275 into, I think this is 1.03 divided by 1.01. 69.8845. 69.8845. So if you don't take the forward rate, it is likely to be 69.8845. But if you take the forward rate, 68.4575, so forward rate is beneficial. Forward rate is cheaper. So forward rate is cheaper. The one quoted, yes, the one quoted, because theoretically, if you wait, the spot will come to 69.88. You end up buying at 69.88. But today itself, if you enter into a commitment, only 68.45. So the forward rate quoted, yes, the forward rate cover, or we can say forward cover, that is what we calculated, and that is cheaper. You can say that forward cover, the first option, is beneficial. The forward cover is cheaper. Rather than forward rate, you can use forward cover. If the forward cover was 70 rupees, then you say that don't take, wait for the spot to come. Spot rate is likely to be less. You go with unhedged position. That would have been better. Okay. They're also asking one more thing. What if the spot rate is 68.4275? Of course, then what would happen? You can recalculate what will be the rate if spot rate is 68.4275. Then can you calculate the forward rates? Theoretical forward rates will be 68.4275 multiplied by 1.03 divided by 1.01. The rate using the IRPT, that is, rate is named or termed as forward rate. You can say this is the expected rate after 6 months. The rate using IRPT is the expected rate. You can say theoretical forward rate, expected rate after 6 months. That means after 6 months, the spot what is likely to be in advance, if you estimate, that is what is IRPT. So that number, if you calculate, I think 69.78. You get 69.78 7825. So here also you can say forward cover is still cheaper. Even here you can say that the forward cover is still cheaper. Forward cover is still cheaper. 69 is higher than 68.
Sir, instead of spot, if they had given 6 months spot, that is, after 6 months, the spot is 68.4275, then we can calculate the loss that the person will
Yeah.
incur by going to forward cover, correct?
Yes, you will get the loss if you know the spot rate, but you will calculate the loss only on that day, not in advance.
Yes, sir.
Yeah. So by entering into forward cover, how much loss you incurred notionally, yes, you can definitely calculate.
Okay.
Or they can also ask you to calculate. In some questions they've asked. By giving the actual rate, they'll ask you what is the loss a person incurred by entering into forward cover. The difference between the forward rate which you entered, spot rate on that date, that becomes the loss if the rate was less. If the rate was more, you would have had a gain also. Okay, good. Just for theoretical discussion purpose, quickly, theoretically, what we're talking about, if I calculate the forward premium, how much it comes to theoretically, 69.8845 you can take. So I think I'll just do it in the next slide. Forward premium, if I calculate 69.8845 minus the spot rate 68.5275 divided by the spot rate 68.5275 multiplied by 100. This is for 6 months. How much for 12 months? 69.8845 minus 68.5275 divided by 68.5275 into 100 into 12 by 6. You get 3.96 percentage, approximately 4%. Oh, you're not able to see the screen. Okay, sorry. But I hope you're able to follow what I'm telling. That the theoretical forward rate is 69.8845. The spot rate is 68.5275. So 69 forward rate, 68 spot rate by 68, like F minus S by S into 100 into 12 by 6. Approximately, I hope you get 4%. And what is the interest rate differential? Between India and US, interest rate in US is 2%, India is 6%. So 6% minus 2%, see it is 4%. That's what I was trying to tell at the beginning of the problem. Theoretically, the premium or how much ever is the interest differential in two currencies should be the currency appreciation. If currency is cheaper by 4% because of interest rate, it will get appreciated in terms of foreign currency appreciation. So if dollar is always at a lower rate, then dollar is expected to be trading at premium in the future years. They can ask you one of the questions like this: what do you expect the dollar to be in the future years? Giving these data points, you can say the dollar is lower interest rate, which will demand higher premium. Currency with lower interest rate is expected to trade at premium. Lower interest rate or lower inflation rate, that means that currency is more valuable and therefore they are expected to trade at a premium. Anyway, this is the conceptual part I just want to discuss. Do you have any questions in this regard? Okay, great. Okay, good. This problem is going to be something like a supplier credit versus bank rate. One typical problem asked in examination. A Limited is planning to import an equipment from Japan. Indian importer importing from Japan at a cost of 3,400 lakhs yen. The company may avail 18% per annum with quarterly rest. What is this quarterly rest? Taking rest after every quarter. Quarterly compounding with which it can import the equipment. The company has also an offer from Osaka branch of an Indian-based bank extending a credit of 180 days or 2% per annum against opening an irrevocable letter of credit. Additional information, present exchange rate, 180 days forward rates, commission charges, advise the company whether the offer from the foreign branch should be accepted. Okay. So here company has two choices. You have imported the equipment, so you pay them immediately. If you pay them immediately, where do you get the money? You need to take a loan, and the loan is you can take from bank at 18% per annum. Second choice, you don't make the immediate payment, you make the payment after certain date. But you know, when a foreign supplier gives you, why will he give you credit? You are a person from different country, that too from India. The credibility may not be there much. So there is some bank which gives guarantee on behalf of you. The company has an offer from Osaka branch of India-based bank extending a credit of 180 days. So they say, you don't make the payment, we will make the payment at 2%. So indirectly, you are taking a loan from foreign bank and you have to pay them interest 2%. And for that, you have to pay interest. And not only that, you also have to open an irrevocable letter of credit, like a letter of guarantee, which has some charges. So, what are the set of events that are happening on alternatives? Hope you're able to follow. Two alternatives are there. Alternative one, you pay immediately and you take loan in rupee terms. Another one, you don't pay immediately, you pay after 6 months and then you pay interest in foreign currency terms. And also, you also going to pay commission charges in that option. Let's quickly list down the list of cash flow that will take place. And based on that, we'll also compute the outflow. Then we choose whichever is cheaper. So one option is to pay immediately. So basically, if you pay immediately, you take loan in INRs, in rupee terms, and then you repay interest. So loan in INR today, and then you pay interest. So whatever the amount you get, this is the cash flow after 6 months. We will calculate whatever the amount. This is one alternative. The second alternative is you avail the offer, that is, you accept the offer of foreign bank or foreign branch of Indian bank. So in that case, you don't make the payment immediately today. You are going to make a payment. Indirectly, I can say you have taken a loan in Japanese yen terms. So after 6 months, you're going to pay, or you can take it like loan in Japanese yen today, and you're going to pay interest in yen for 6 months. So whatever you get is that cash flow after 6 months. But this loan is expressed in yen terms. Interest also is in yen terms. So the cash flow after 6 months also comes in yen terms. The treatment for accept offer from foreign bank is same as credit from supplier. Yes, you can understand it as same. Yes, definitely you can treat a problem which has foreign credit, supplier credit is same as accepting offer from foreign bank. Essentially, my dear friends, this is a case of local borrowing versus foreign borrowing. Local bank, local borrowing. Supplier is charging you interest, that is a foreign borrowing. Or you're taking a loan from foreign bank and making payment, so you're paying interest to the bank, foreign borrowing. So essentially, it is a problem of local borrowing or foreign borrowing. Hope you get that point. Okay, so in this case, you're accepting offer from foreign bank, you are having the loan in yen foreign currency terms, interest in foreign currency terms. So cash flow after 6 months will also be in yen terms. But you see that the cash flow you have to express in rupee terms, therefore I'll have to multiply it by exchange rate. Now the exchange rate should be spot rate or forward rate. Now because this is the payment to be done after 6 months, I'll have to multiply it by 6 months forward rate. We'll come to the amount. Now this will give you the cash flow or total repayment in rupee terms. Total repayment in rupee terms in INR. But is this the only amount which is going to be paid? No, you also have to pay commission, because bank is giving letter of credit, like a letter of guarantee. For that, a bank is charging a commission, and the commission also is going to be an outflow. Now commission is again expressed in yen terms, commission expressed in yen terms, and I have to express in rupee terms, so I'll multiply it by exchange rate. Then I'll get commission in INR terms. Okay, now let's calculate the amounts. So what is the loan in INR today? Please observe. Uh, yes. First of
So
all, yes,
this
please go ahead.
so this commission in yen terms, this exchange rate will be the 6 months forward rate or spot rate?
Yes. So now the question is, commission is payable on which date? Like interest and loan, repayment is after 6 months, so we have taken 6 months forward rate. Now the commission, if it is paid immediately, then you apply the spot rate. If the commission is paid after 6 months, then it is forward rate. Let's see the question what they mentioned. Commission charges for letter of credit 2%. They have not given whether it is paid today or after 6 months. So then we have to apply what is the normal course of action. Normally, when you pay a commission, it is not an interest like you pay after 6 months. Commission is payable immediately. For getting a letter of credit, you have to pay like a bank processing charges, loan processing charges. So commission is payable immediately, and therefore the exchange rate what you have to apply is spot rate. There's one more element to it. I'll come to it at the end. Now, first point first. Here, should I multiply or divide? Now, for that, which currency is given? Yes, any doubts? Please go ahead.
So in the questions, unless otherwise stated, we will always take spot rate, no, sir?
No, I mean, in the sense you mean for commission.
Yes, for the
Yeah,
commission only.
for commission, any processing charges they mention like that, those things are paid immediately normally. So you apply spot rate. Okay, so try to apply now. Which currency is mentioned in the problem? In this case, buy or sell later 3,400 lakh yen, and you please compare and tell me that is right hand side or left hand side. This is right hand side, so right hand side means what we should do? We should divide, and we don't have to worry about lower rate and higher rates. Therefore we don't have to worry. But if at all, if we have to worry about it, yen we are going to purchase will be at a higher rate, because right hand side it would have been 1 divided by lower rate. 1 by lower would have become higher, but anyway, you don't have to worry about it now, because it only one rate available. So spot rate 3,400 lakh yen multiplied by, this is not 1 equals to 100 equals to, so it's not 1 divided by, it will be 100 divided by 340. So loan today 3,400 lakh yen is everything in lakhs. This also I'll make it as in lakhs, multiplied by 100, not 1 by 100 divided by 340. I think you get 10 and 3,400 into 100 by 340. 1,000, right? 1,000 you get. Okay. This is rupees 1,000. Now, interest for 6 months. How much interest is payable? 18% per annum. So normally what will I do? 1,000 into 18% into 6 by 12. But they said it is quarterly rest. So we have to compound quarterly. So I cannot calculate interest like this. I have to use the formula of future value equals present value into 1 plus r to the power of n. Because compounded quarterly, rate of interest I'll divide by 4 and number of years I'll multiply it by 4. The present value is 1,000 into 1 plus rate of interest 18% divided by 4 to the power of n. N is number of years, 6 months. So n will be 0.5 multiplied by 4. Effectively what happens in the power? 0.5 into 4, which is 2. So in a 6 months, you get 2 quarters, right? That's what this 2 represents. But anyway, formula wise, if you are clear, you don't have to worry too much. So 1000 multiplied by 1.045 to the power of 2. So you get 1000 into 1.045 into 1.045. 1092.03.
So,
Yes.
so the point raised to n into 4, n would be 6 months.
6 months. So 6 months you have to express it in years. Right? 6 by 12. 6 by 12 is half year. Or you can write 6 by 12 also. Instead of writing 0.5, you can write 6 by 12. N should be in years.
So and the 4 so that we have multiplied, that's the 4 quarters.
Quarters. So whatever you
So,
divide, same thing you multiply. And that 4 is because component quarterly for that reason. You can also calculate in one more way. Like every quarter, if you calculate, like first quarter, how do you calculate? Thousands into 18% into 3 by 12. So what do you get if I do that one? 1000 into 18% into 3 by 12.
45.
You get
45.
45. So how do you calculate for the second quarter now? You don't do it on 1000 because it compounds, right? So you calculate on 1045 into 18% into 3 by 12. You get 47.025 or 47.03. So you can add now 1000 plus 45 plus 47, it will come to 1492 only. So you can calculate one quarter interest separately, like, but you have to calculate manually every time, or you can use the formula, regular compound interest formula. You get the same answer. I showed you both the methods.
Yes. Thank
See
you.
if you're able to follow it. And what I, in the formula, what I divide here is whatever is the frequency of compounding, I'll divide. In a year, quarterly means 4 times. So divide by 4, multiplied by 4. If it is a half yearly, I'll divide by 2, power I'll multiply it by 2. N is always the number of years. Okay. Now, similarly, if I go for the second option, if you accept the offer, you get the loan of 3,400 lakhs and interest is at the rate of extending a rate of 180 days and 2% per annum. Okay. So you can do again 3,400 into 2% per annum you can do, or you can do it in number of days base. That's approximately is fine. So I'll do it in number of days. That is 3,400, 2% for 180 days. So 180 by 365. Even if you take 6 months, 6 by 12, that's completely fine, accepted. Small difference will come, but that's fine. 3,400 into 2.02 into 180 by 365. 33.53. So 3433.53. 6 months forward rate. Again, remember I have to divide. So 100 by 345. So you should do 100 by 345. That will be repayment in rupee terms. 3433.53 into 100 by 345. 995.23. 995.23. Commission in yen, they said commission 2%. Now commission 2%, oh, this also is for 12 months. Is the question also like that? Commission 12% for 2% for 12 months. So this also I should do number of months I am going to do. That is, okay, on 3,400, commission of 2%, but for proportionately we calculate. So 3,400 for 2% for 12 months. So this I'll take it as 6 by 12. So how much you get? 34. Huh? So commission in yen in 34, and exchange rate, as I told you, because the commission is paid immediately, we'll take the spot rate of 100 by 340. So into 100 by 340. So commission INR is you get as 10. Okay. Now, when this 1092 is taking place after 3 months, after 6 months, when is this 995 is being paid? After 6 months. But when this 10 is paid immediately today, so this 10 is paid today, that's not rightly comparable. This also has to be converted into after 6 months, then only the number can be directly comparable. In other words, this is the amount that you have to pay today, but you don't have any source. Obviously, you have to take a loan. Now, this 10, which loan will we apply? Rupee loan or yen loan? You are paying in yen, but you have to borrow equivalent amount of rupees today. You can't take loan in yen and pay them in yen. You can't take loan from them and pay it to them. I am not sure whether you're able to follow. I'll explain once more. You have to pay commission in yen, and that yen I purchase in the market. But for that I need money. So I am going to borrow in my local bank. And local bank is going to charge me that 1.045 18% quarterly rate of interest. Therefore, its equivalent amount after 6 months, along the equivalent amount after 6 months, this amount will be 10 into same term I'll apply this 1.045 square. I mean, I don't have to show the detailed calculation again. Hope you understand. 1.045 square. You get 10.9. So the total outflow under this option is 995 plus 10.92, 1005.92. So here 1092, here 1005. So the offer from the foreign bank is cheaper. So this option is beneficial. The offer is beneficial. This option is cheaper. So just be careful about the last part of the calculation and see if you are able to follow it. It should be 1006. Is it? have I calculated wrongly? Now, okay, 0.23 was there. Correct, correct. 995.23 plus 10.92. Yeah, 1006. Yes, yes, sorry. 1006.15. Yeah, I'll just change it. 1006. Either a 0.23, I missed to take it. Yes. 1006.15. 1006.15. Yes, corrected. Okay, let's go further. I hope no doubts on this one. This is one typical problem, I will say. Looks so big, but conceptually, it is IPCC level problem. Anyway, let us read. Sometimes we believe in, first out. So you might have forgotten. Let's revise some concepts of capital budgeting. Let's read. A US based company is planning to set up subsidiary company in India where so far it was exporting. In view of the growing demand for its product and competition from other US based companies, the initial project cost consisting of plant and machinery, including installation, estimated to be 490 million. You are talking about a US company coming into India. You have been exporting to India, but now you see competition. So you want to come to India and then establish a manufacturing unit. That will have some cost. So now when you're analyzing, before you even read further, what's your mind tell? You are having two alternatives. Continue to export like today, or you start a unit. If you want to start a unit, there will be some cost, which we are going to analyze. And even if you continue to export, that will also give you cash flow. So if starting a units makes sense, then you should justify that the incremental benefit should be covering the cost. You're getting my point? When you want to make a decision, you should always go for the incremental benefit. Do you remember somewhere a similar concept was there in bond valuation, where you will have an existing bond, bond, and you're planning to replace with new bond, and you always went for incremental cash flow approach. The same logic you have to keep in this problem as well. Anyway, we'll discuss. Initial project cost consisting of plant and machinery, installation cost 490 million. Net working capital requirements are estimated to be 60 million. What is the uniqueness of working capital? And installation machinery cost? Machinery cost, you invest now, and at the end of useful life, you get scrap value. What is working capital? Is it investment? It is not machinery, no depreciation. But working capital represents logic, amount set aside for day to day purposes. It is not available for the utility purpose. It is amount blocked. And therefore, working capital is considered as initial investment along with purchase price. And when the project is over, that net working capital will be released and that will be part of residual value at the same amount. To that extent becomes free. See, this working capital works like minimum bank balance. So at any point in time, you cannot have a balance before below 5,000. So that 5,000 is blocked. So that is an investment for us as long as the bank account is active. Once the bank account is active, that 5,000 comes to your hand and you can use it freely. So for capital budgeting purposes, working capital will be considered as outflow as part of initial investment. When the project is completed, exact same amount is called as release of working capital and that becomes inflow. So then what is the difference? I take minus initially, plus later, effectively zero then, minus also, plus also. No, time value of money will have to be considered. Because today you will have investment. Today value is 1 rupee. But after useful life means what money you get will be adjusted for discounting factor to get the present value. So there lies the impact. The company follows the straight line method of depreciation. Currently, company is exporting 2 million units every year at a unit price of $90. Its variable cost is 50. So currently, $90 and 50. So if you don't start a unit, still you will get profit of $40 multiplied by 2 million. So when you're thinking about incremental profit, keep this point in mind. The CFO of the company has estimated the cash flow from the operating cost and other data as proposed project. Variable cost will be $30 per unit. Additional cash fixed cost will be 30 million. A share of allocated fixed cost will be $3 million based on the principle of ability to share. Expected life of the proposed plant is 5 years, no salvage value. Production capacity proposed project is 5 million. Though they have given production capacity, we'll have to assume that it is used at full capacity because they said they have enough demand and they have not told how much capacity is utilized. We will assume that it is at full capacity. Estimated working capital investment production of sale of 2 million units through export was 25 million. Interesting point. You're having a requirement of 60 million working capital and 25 million is already in use because you're exporting. Debtors will be there, inventory will be there, creditors will be there. You're already having a working capital of 25, and each step I told you, be it profit, be it investment, be it working capital, your approach should be incremental approach. From the present decision to the new decision, how much additional amount I will invest. So if the project requires 60 million, I'm already having 25 million, which I no longer require, right? The moment I start a unit, I'm not going to export from my country. The 25 million will be released and that can be used. In other words, only the incremental 35 million will be considered as initial investment and the same will be recovery of investment when the project life is completed. Export of the product in the coming year will decrease to 1.5 units provided the company does not set up subsidiary in view of the presence of the competing from other US based company that are in the process of setting up their subsidiary in India. So again, the same approach I was trying to convey. You have an existing unit, existing process, and I tried to start a new unit. All your cash flows, all your calculations should be incremental. applicable for investment, working capital. And in the past, you are exporting 2 million units, and now you are comparing with starting a unit which will have 5 million units capacity. But in the next point, they said if you don't start, your export will be 1.5 million units. So, which is the correct comparison? 2 million with 5 million or 1.5 with 5 million? It is 1.5 with 5 million. 2 million is past history that has no role to play. Even if you don't do anything, I have two choices. Either I export or I start a unit. If I export in the future, I'll be able to sell only 1.5 million. And if I start a unit, I can have a capacity of 5 million. So 2 million is a redundant information. Applicable corporate tax 35, required rate of return 12, discounting rate, assuming there will be no variation in exchange rate of two currency and all profits will be repatriated as there will be no withholding tax, estimate NPV of project in India and give advice. Basically, we require NPV. And whenever you get a big problem like this, you always divide the problem into three cash flows. Initial cash flow, what will happen? Interim cash flow, what will happen? Terminal cash flow, what will happen? Initial, when you start a project. Interim, during the project is alive. Terminal, when the project is completed. So let's apply that approach. So initial cash flow, interim cash flow, and then terminal cash flow. Okay. And everything you try to think on incremental approach. So what is the cost of the plant or investment in plant? These are all million. So let's say $million. It requires a 490 million outflow. So I'll write within brackets. Then working capital. Working capital, you need a 60, but presently you're already having 25. So we'll take only incremental 35 million outflow. 60 minus 25. So total outflow today is 525. And this already in present value terms. Today things we don't have to worry about the any present value application. You can take these amounts as it is. Okay, and then what will come in terminal cash flow? These things will have terminal value. That is, cost of the plant will have salvage value. And working capital will be release of working capital. Salvage value is 0, correct? Expected life is 5 years and salvage value, no salvage value, 0. And working capital, how much released? 35 only you should take. Sir, 60 gets released, correct? But two, incremental approach. Even if you don't have this project, the working capital 25 will continue. So when after some years, the 25 gets released, here 60 is getting released. So working capital, please apply incremental approach, 35. So total 35 will come, but you multiply it by discounting factor. That year discounting factor to get the present value. I think that is there in the question. They would have given 0.5674. That is there in the material. Anyway, discounting factor 12%, 1 by 1.12 equal to 5 times you get, or in the examination question, they'll give it to you. In fact, this question also has it. So 35 into 0.5674, 19.859. 19.859. Okay, this is the terminal cash flow. Now I'm coming to interim cash flow. Interim cash flow means you have to compare two cash flow. That is the cash flow by starting a unit and the cash flow if you continue to export. The incremental amount will take minus cash flow if export is continued. Okay, now what is the existing part? I mean, if you start a unit, uh, number of units is 5 million. Okay, let's do something. Let's do like a sales minus cost. I think we have variable cost, we have fixed cost, maybe we have depreciation, we get profit before tax, and then subtract tax, you get profit after tax. Sales, selling price is $90, number of units is 5 million units. Currently selling price cannot change. 90 into 5 million, 450. Then variable cost. Variable cost don't take 50. That is if you follow existing one. But if you start a unit, it will be 30. So 30 multiplied by 5 million units, 150.
So
Yes, please.
there is no variable cost per unit being $50. What is that variable cost and the variable cost mentioned in one?
The first one, what they've given $50 is their current cost of production, where they manufacture in their country and they export it to India. This will be used in the next column when I'm calculating the alternative. If I don't start, if I continue to export, my cost of manufacturing will be $50. But if I come to India, the cheap labor cost in India, many of the cost is a less. So in India, the cost of production is only $30 per unit. So it's between the two alternatives. If you manufacture in US, it costs you $50 per unit. If you manufacture in India, the variable cost is $30 per unit. So here I'm comparing with the starting unit. So I'm taking $30. Later, when I'm doing second column, I'll take the $50. Coming to the fixed cost. Additional cash fixed cost is 30 million. Yes, that will subtract But what about this share of allocated fixed cost, your relevant costing concept, strategic management concept? Because company is starting a new unit, you will allocate to them also. But if you don't start a unit, you will allocate it to remaining units. In the sense, whether you start this unit or you don't start the unit, your overall cost will not change. That is, if you have, let's say, 120 million to be allocated, if you have 4 units, you allocate 30 each. If there are 3 units, you allocate 40 each, but ultimate cost will remain same. This amount allocated is only on the principle of ability to share. It is not an incremental cost. It is not a cost that you incur just because this unit is started. You would have incurred the total cost anyway. Therefore, this 3 million per annum allocated fixed cost, principle of ability to share, that will not be considered. So that is zero. That will not be considered. So depreciation, cost of the plant is 490, scrap value is 0, divided by useful life of 5. So what you get is now profit before tax. How much you get? 490. Just 1 second. Okay, so 490 divided by 5, 98. 450 minus 150 minus 30 minus 98. You get 172. 172 minus tax 35%, 60.2. So you get profit after tax 111.8. But we don't need profit after tax. We need depreciation. So what should I do? I'll just take it a little bit down so I can get some space. I'll have to add back depreciation. For profit, I add back depreciation. What I get is cash flow. Depreciation is 98. Cash flow after tax 209.8. Then I'll get this space for terminal, and this would be salvage value 0. Okay, I'll just zoom it up just for your reference. Sales 450, variable cost 30 into 5 150, fixed cost incremental 30, share of allocate cost I have not taken, depreciation 490 minus 0 by 5, straight line depreciation 98, so you get profit before tax 172, tax at 35% 60.2, profit after tax 111.8, add back depreciation, what you get is cash flow after tax 209.8. See if you have any doubts on this one. Okay, so hope you are able to do it. Now, existing, if you continue the process, for the tax basis, should we deduct the allocable fixed cost and then add it back? No, we are not calculating the profit from this unit. And try to imagine, even if this unit is not there, somebody else will claim the expense and get the same tax benefit. So we are not trying to calculate the tax this unit pays. We are trying to calculate the incremental profit or attributable profit and tax impact on that. If you do like this, no, if you subtract fixed cost, then subtract tax, then add back fixed cost, that means you're telling me if this project was not there, I won't get the tax benefit. Nothing like that. If this project was not there, somebody else will claim the amount and they will get the tax benefit. So that expense has no role to play as far as your decision making is concerned, either on the expense side or on the tax impact side. Okay, so if you go with the existing export, how much sales you get? You can only make 1.5 million units, selling price is 90. Do not take 2 million. If you don't start, your sales will come down to 1.5. That is the number to be compared. Minus variable cost. Now variable cost is not 30. I'll take variable cost of this number, which is 50. So 1.5 into 50. We have no information on fixed cost, no information on variable cost, no information depreciation. You can ignore that. 135, 75. So profit before tax is 60 minus tax 21, and profit after tax is 39 and no depreciation. So this itself is cash flow after tax. No information on depreciation. So cash flow is 209.8. If you calculate, if you start a unit, if you don't start a unit, cash flow what you get is 39. So what is the incremental cash flow you get? Incremental annual cash flow is 209.8 minus this is 39. 170.8. But 170.8 will be there every year for 5 years. So I should apply present value. So multiplied by annuity factor at the rate of 12% for 5 years. They have given the 5 annuity factor. You can simply add it. So the present value will come to 170.8 multiplied by the annuity factor. I think that is 3.6048. And I hope you know how to calculate those annuity factors. So present value is 170.8 into 3.6048, 615.69998. 615.6998. So what is the overall NPV? This 525 is already in present value terms. 615.6998, we got it in present value terms by applying annuity factor, and 19.859 is also present value terms because we apply discounting factor. So NPV, incremental NPV plus 19.859 minus 525, I think 110.5588. 110.5588. So NPV is more than 0. the project should be accepted. Project is financially viable, or you can say project should be accepted. Okay, this is one typical problem asked in the exam quite a few times. See if you require any clarification. This has been asked in the exam like numerous times. So many times they ask, they keep asking it because some of students keep missing this problem. Okay, so let's go further. Okay, so let us take up this problem. A dealer quotes all-in cost for a generic swap of 6% 6% against 6-month LIBOR flat. So what is the interest rate swap basic concept? There has to be two parties. One party should take a fixed rate position. Another party should take floating rate position. So in this problem, the swap is fixed rate of 6% and LIBOR flat. That is variable rate, fluctuating rate, floating rate. If the notional principal of the swap is 8 lakh, calculate the semi-annual fixed payment. After all, it is a 6 months LIBOR, so semi-annual payment will take place. Find the first floating rate for one above. If the 6-month period from the effective date of swap to the settlement date comprises of 181 days and the corresponding LIBOR was 15%, 5% on effective date of swap. In 2 above, if the settlement is on net basis, how much the fixed rate payer would have to pay floating rate payer? Generic swap is based on 30 by 360-day basis. Now here, yeah, I don't know the name of these people exactly, but just for discussion purpose, let's say Mr. A is there and Mr. B is there. A is paying a fixed rate of 6% and B is paying a floating rate of LIBOR. And how much is the LIBOR rate? We will not know now. We will know only at subsequent period. That's called as reference dates. Just the question. I've not solved anything in detail. Oh, a question you are not able to see? No. Just the question. I've not solved anything. Okay, fine. It's fine. Good. Uh, so two parties are there. One party have a fixed rate of 6%, other party have a floating rate of LIBOR. And LIBOR rate we will not come to know now, we will come to know only later. And when you come to know, you know the who has to pay to whom, and you have to convert it in rupee terms. I mean, maybe foreign currency means dollar terms. That percentage is to be applied on certain base principle. It is what is called as notional principle, just for settlement purpose, and settlement will take place on net basis. If interest rate increase, then fixed rate person will enjoy the benefit. If interest rate falls, the floating rate person will enjoy the benefit. It is not only in swap, generic understanding have this. When you have taken a loan at 8%, if market rate goes up, you are not bothered, you are fixed rate. That's what I'm trying to tell. When the market rate goes up, fixed rate person enjoys the benefit. If market rate comes down, floating rate person end up paying less, he will enjoy the benefit. I mean, everybody will have a benefit. Your expectation should come true. Let's keep that aside. Solution is very simple. Let's focus on that. Calculate semi-annual fixed payment. The first part of the question, semi-annual. Hope you're able to see what I'm writing. Semi-annual fixed payment. Yes, okay, great. Amount of loan is 8 lakh multiplied by 6% for a period of 6 months. These are all 6 months loans. I think 24,000. Okay. Second, find the first floating rate. Now, floating rate means that day should come, and that day has come. 6 months period from the effective date of swap, and LIBOR was 5% on that day. So at 6 months, we take 5% for settlement purpose. 6 months later, LIBOR will change. We take that number for settlement purpose. The value will keep changing, and that's why it is called as derivative. And they said you comprise of 181 days and you take 30 a day a month, 360 day a year basis. So floating rate payment. First, floating rate payment, which is 8 lakh multiplied by LIBOR was 5% into not 6 by 12. They said you take 181 days and take a convention of 360 days. So 181 by 360. So if you calculate, I think you get 20,120. It lakh into 5% into 181 by 360. Oh, 20,111. Okay, 20,111. And if the settlement is on net basis. Now, before even we calculate, what happened to the rate of interest, can you analyze? LIBOR is 5%, which means the interest rate has fallen, right? Interest rate, I mean, it has reduced. Now, when interest rate is below fixed rate of 6%, so who would enjoy the benefit? The rate of interest has come down, so floating rate person will enjoy, fixed rate person will pay more, and that's what they're asking. How much a fixed rate payer would have to pay? So if settlement is on net basis, if settlement is on net basis, then fixed rate payer should pay 24,000 minus 20,000 111 3839 3889. That is when floating rate is less, floating rate is less, floating rate person will receive the benefit. When the floating rate is less, floating rate payer gets benefit. When fixed rate is less, the fixed rate payer will get the benefit. Okay, so from exam point of view, this is what they have asked. This much is sufficient. See if you have any doubts. Okay, good. Okay, so let us take this problem on equity valuation. Let us read. Excellent Limited reported a profit of 154 lakhs after 30% tax for the financial year 1920. They have given earnings. An analysis of the accounts revealed that there is an extraordinary loss of 20 lakhs. What is the importance of this word? Extraordinary loss. This will not be recurring. Extraordinary, not ordinary. Therefore, for valuation, when I compute earnings, this loss should be removed. And remove, how do you do? Not by subtracting. The profit would be obtained after subtracting this loss. So if you have to remove it, you should add back. But this loss was before tax, but the profit is after tax, not matching. So what should I do? From the profit of after tax, first I have to take it backwards. I should calculate before tax. How do I do before tax? I have to add back tax. So one way of adding back tax, or what you can do, you divide by 1 minus tax rate. What do you mean by that? From before tax, if I have to come to after tax, I'll multiply it by 1 minus t. Therefore, from after tax, if I have to go to before tax, I will divide by 1 minus t. 1 minus t is multiplied for after tax. 1 minus t is divided to arrive at before tax. Then you can do this adjustment. And the income included extraordinary items of 16 lakhs. And this is also extraordinary income to be eliminated. It was added earlier. Now you subtract. The existing operations, except for extraordinary items, are expected to continue in the future. We can call it as the future maintainable profits. In addition, the results of the launch of the new product are expected to be as follows. The new product, additional cash flow, which was not there earlier, we will get in the future. So you consider it. The sales minus material cost, minus labor cost, minus fixed cost, it is the additional profit that will come in the future years. You are required to calculate the value of business given the capitalization rate is 14%, Determine the market price per share with excellent limited share capital being comprised of 2 lakh or 13% preference shares of 100 each and 1 crore equity shares of 10 each. Oh, preference share is also there. So there will be preference share dividend to compute EPS. And the P ratio being 12 times, ignore profit dividend tax. Anyway, we ignore. This is not in application now. Okay. So let me just produce the institute solution as it is. So first what we should do, we have to eliminate the extraordinary loss and the profit. Extraordinary loss I have to add back and extraordinary profit I need to subtract. And for that purpose, we have to first get from profit after tax, you have to go back to profit before tax. And for that purpose, what should I do? As I explained, I'm going to do 1 minus tax rate. I will divide by 1 minus tax rate. So please observe, then I'll give the time for you to write it down. We have profit before tax of 154. 154, no, that is a line item. This ignore. So 154 is the profit after tax. I need before tax. So I'll divide by 1 minus T. I get 220. Extraordinary income is subtracted. Extraordinary loss is added back. So thereby you get the new profit. You can say future maintainable profits contribute from existing operations. But new product is coming that will add to our cash flow, add to our profits. Therefore, sales minus this material labor fixed cost that will give you the incremental profit and thereby existing corporations so 224, new product 56. So total 280, you pay tax of 84, you get profit after tax of 196. And they have given the capitalization rate. So what you can do, the value of company can be calculated by the profit after tax divided by the cost, that is capitalization factor, cost of capital. So profit is 196 divided by capitalization factor. So what you get is the value of the business. So you can take down the first part of the question, computing value of the business, and see if you have any doubts. Okay, is it done? Yes. Okay. So let's go for second part of the question. Determine the market price per equity share. And by using P ratio method. How do we calculate using P ratio method? EPS multiplied by P ratio. How do we ascertain EPS? We have existing profit now, profit after tax. You divide by number of shares, but before that we should also pay preference share dividend. So profit after tax minus preference share dividend will give you earnings to equity shareholders. Divide by number of equity shares, you get EPS. EPS multiplied by P ratio, you get the estimated market price per share. So let me ascertain that. Again, let me calculate first. And after that, okay, let me explain it. Then you can take it down. Future maintainable profits. See what I just given. 1 crore 96 lakhs. This rupees in lakhs. Subtract preference share dividend. They have given, right? What they have given? 2 lakh preference share dividend of 100 each. Rate is 13%. So 2 lakh into 100 into 13%, 26 lakhs. Earnings available, so 1 crore 70 lakhs. Divide by number of equity shares. They have given number of equity shares. You get EPS of 1.7. Multiply by P ratio, you get 12. So you get estimated market price. In fact, you can also calculate market cap. Market price per share multiplied by number of shares will give you market cap. And not only that, even the profit earnings, whatever is there, you multiply it by P ratio, that also will give you the market cap. Anyway, write down till here. Okay, good. Okay, let's go further. Any doubts on this one? Okay, good. Okay, so next problem. The following information is provided relating to acquiring company efficient limited and target company healthy limited. Number of shares, face value 10, 20 lakhs, 15 lakhs. Market capitalization 800 lakh, 1200 lakhs. P ratio given, reserves and surplus given, promoters holding is also given. Board of directors of both the company have decided to give a fair deal to the shareholders, and accordingly the swap ratio decided are 45%, 20%, 35% respectively for earning, book value and market price. Swap ratio means number of shares issued for every shares existing, applicable when settlement is by issue of shares. The basis of swap ratio can be many things, and formula is target by acquirer. And in this problem, it is not one method, it is multiple method. Yes, we are going to take a weighted average. Calculate the swap ratio and also calculate promoters holding percentage after acquisition. What is the EPS of Efficient Limited after acquisition of Healthy Limited? What is the expected market price per share of market capitalization of Efficient Limited after acquisition? Assuming P ratio of Efficient Limited remains unchanged, calculate free float market capitalization of merged firm. Free float market cap means the value of shares held by non-promoters, public, because promoters don't trade in the shares day to day, right? Like for example, Mukesh Ambani in Reliance is busy in running the business. He will not buy and sell his shares. So promoter shares you take it out, remaining shares non-promoters public, that is called as the value whatever those shares are there, that is called as free float market cap. That's what they're asking. Only 4 questions. Okay, let's calculate. Okay, so let's start with the format which we usually always do. Then we'll see whatever information additional or some changes. So we will write the heading, which is efficient, nothing but acquirer, healthy, nothing but target. And you can write one merged entity. So whatever we have, we will usually require information on earnings, number of shares, EPS, P ratio, market price per share, something like that. I mean, we may not require all information, but standard you can write. Earnings, no information, but they want EPS. Interesting. Number of shares that we have 20 lakh, 15 lakh. EPS not given. Market capitalization they have given. Okay, market cap. Market value they have given. 800 lakhs, 1200 lakhs. Lakhs means 5 zeros. Or you can write lakhs also, that is fine. P ratio 10 and 5. Okay, reserves and surplus, number of shares, face value. Okay, so now let's calculate what is possible. we have market value and we have P ratio. So what we can calculate using market value and the P ratio, I can compute earnings. Market value divided by P ratio is earnings. Earnings number of times P ratio is market value. Or you can also do market value divided by number of shares, we'll get market price per share. And market price per share divided by P ratio is EPS. Any way you want to calculate, you can do it. Okay, let's go by market price per share first, which is calculated as 800 lakhs divided by number of shares 20 lakhs. And here 1200 lakhs divided by 15 lakhs. So market price per share, is it 40? Lakhs also get cancelled, huh? And 1200 by 15, 80. Oh, 40 and 80, is it? Okay. P ratio we know, so we can calculate EPS. That is market price per share divided by P ratio. So 40 by 10, you get 4 times, and 80 by 5, 16 times. 4 and 16. No, something wrong. 4 and 16 are correct. EPS, sorry, not times. EPS is 4 rupees. 4 and 16. EPS 4 and 16. Okay, earnings, you can do number of shares into EPS, or you can do market value by P ratio. Both are fine. Let me do EPS into number of shares. So 4 rupees EPS multiplied by number of shares 20 lakh. So that is 80 lakh. 16 rupee EPS into 15 lakh. Think 240 lakh. Okay, fine. Okay, so basic data points, whatever we required, we could calculate. Now let's go for what they've asked. Swap ratio based on so many things. What and all is there? Swap ratio based on earnings. That is EPS. We have market price. We have book value. I don't have. So let me calculate book value. Let me do it in the same column. That is book value is asset minus liability, which we don't have information. Other method is share capital plus reserves and surplus. That I can do it. Share capital and reserves and surplus. Share capital, number of shares multiplied by face value. Number of shares 20 lakh, face value 10. 20 lakh into 10. So 200 lakhs. If you don't feel like writing too many zeros, you also put it as L, or heading you can give rupees in lakhs, and that is also fine. Here 15 lakhs into 10. 150 lakhs. Reserves they have given 400 and 273. So net worth, and that means book value, 600 lakhs and 150 and 273. So 423 something, I think. 150 and 273. 423 lakhs. Divide by number of shares, you get book value per share. Book value per share, you divide by number of shares. Divide by 20 lakh. Divide by 15 lakh. So 600 lakhs by 20 lakhs. So 30 rupees. 423 lakhs by 15 lakh. 28.2. Okay, I hope it is done. Shall I go to the next slide? Because I'm going to use EPS as one ratio and MPS as another ratio and book value per share as another ratio. So these are the three things which is required to calculate swap ratio, and then we are going to take an average of it. Okay, I hope it is done till here. Okay, let's go for the calculations, what they have asked. Swap ratio and promoters holding. Okay, first thing, weighted average swap ratio. So you can say whatever the ratio or parameter, ratio, then the weight and product. It is based on respectively earnings, book value, market price. Earnings per share, book value per share, market price per share. And in general, please understand swap ratio is calculated as target divided by acquirer. Unless when the ratio is unfavorable. When the lesser the ratio, the better it is. especially in case of bank merger, where NPA is lesser the good. So in those case, the formula will be reverse, acquirer by target. In other case, target by acquirer. So the ratio EPS 16 and 4. So 16 by 4 means 4. Book value per share 80 by 40. So not there. 28.2 by 30. Whatever the decimal comes, then 80 by 40, which is 2 times 0.94. Okay, the weights. Uh, 45, 20, 35. 45.45, 20.2, 35.35, and always ensure the weight total is equal to 1. So 4 into 0.45, 1.8, 0.94 into 0.2, 0.188, 2 into 0.35, 0.7. Total 2.688. 2.688. Weight is book value weight is 2520. I'm taking the same order, right? 45%, 20%, 35% respectively for earning book value market price. So 45% is earning, 20% is book value, 35% is market price respectively. So 2.688 swap ratio is 2.688 is to 1. So if you want to calculate what is the number of shares issued, for every one share, you're going to issue 2.68 share. Number of shares of Healthy is a 15 lakh. So 15 lakh into 2.688. 40 lakh, 32,000. 15 lakh only, no? Yeah, 15 lakh. Okay, they asked one more thing, promoters holding after merger. What you're going to do, first you calculate the total number of shares and number of shares held by promoter. So promoters holding will be calculated as number of shares held by promoters divided by number of shares of merged entity into 100. What is number of shares held by merged entity? Existing share plus shares issued. Existing shares is 20 lakh plus 40 lakh 32,000. Very interesting situation. Huh? This company 20 lakh, new company, I mean, acquirer company 40 lakh. So essentially, the company which is being acquired, I mean, target, they will take over. So if you apply Ind AS 103, it's a case of reverse acquisition. Anyway, just for your reference, I told. Number of shares held by promoters. What about promoters? Existing 8.65 plus 9 lakh. So 8 lakh 65,000 existing plus 9 lakh, I cannot do it because 9 lakh is replaced by the swap ratio. So I'll multiply it by swap ratio. 9 lakh multiplied by 2.688. Just like EPS I did, just like MPS I did, same thing for number of shares multiplied by the swap ratio into 100. So 9 lakh into 2.688 plus 8 lakh 65,000. 32 lakh 84,200 divided by 20 plus 40, 60 lakh 32,000 divided by 60 lakh 32,000. 0.5445. 0.5, okay, I think multiplied by 100, so 54.45%. Okay, so this is promoters holding. This will helpful in solving the last part of the problem, that is free float. There 1 minus promoters holding I'll take. Okay, let's go further. Calculate the swap ratio we have done. Promoters holding we have done. What is the EPS of Efficient Limited after acquisition? EPS of the merged entity. So we can have 80 lakh plus 240, 80 lakhs plus 240 lakh. So merged entity will be 320 lakhs. The number of shares will be, we already know, denominator 60 lakh 32,000. We can calculate EPS 32 lakh 320 lakh by 6 lakh 32. Anyway, let's write it what they've asked. EPS of merged entity that is earnings of the merged entity divided by number of shares of merged entity. Earnings of merged entity, I just told you 320 lakhs. Number of shares 60 lakh 32,000. $5.305, we can make it as 5.31. Or you can say 5.305 also. 5.3050. You can keep 2 decimals, 4 decimals, that's fine. 5.3050. Next, they asked how many decimals should we write in exam? That's what I told you, your comfort. You can go with 2 decimals or 4 decimals. For annuity factor and all, I would say you go with 4 decimals. And for these calculations, final answer you can keep in 2 decimals. You can round off this to 5.31. That's fine. Third part of the question, what is the expected market price per share and the market capitalization? So two things are there. Expected market price per share after merger, and another market value or market cap of merged entity. So expected market price per share after merger is calculated as EPS of merged entity multiplied by P ratio. EPS is 5.3050 multiplied by P ratio of the merged entity, that is 10, will continue as it is. So you get 53.05. Market capitalization is number of shares of merged entity multiplied by market price of merged entity. Number of shares is 60 lakh 32 into EPS 53.05. You can also compute earnings of the merged entity into P ratio. That's also fine. So 60 lakh 32,000 into 53.05. I think 31.99. Actually, it comes to 32 crores. But anyway, whatever comes, I'll write it. 31.99, 97,600. Actually, if you go for earnings, it is earnings is the 320. I mean 3 crore 20 lakh multiplied by P ratio of 10, you get 32 crores. That's exactly 32 crores, or you can say approximately 32 crores, or you can write it, or profit earnings of the merged entity into P ratio. Earnings is 320 lakhs into P ratio of 10. So you get 3 crore 20 lakhs. $760. I've taken 53.05. 60 lakhs 32,000 into 53.05. 31, 99, 97, 600. That's what I got. Maybe you have taken 53.1. For that would be the reason. I think this is fine, right? Okay. Okay, so let me do the last part of the question. I think they've asked free float market cap. Let me do it here itself. Free float market cap. And this is calculated by the value of shares held by non-promoters. Anyway, promoter percentage I know. 1 minus of that I'll do. I'll get non-promoters, which is public shareholding. So market value of merged entity multiplied by 1 minus promoters holding. Market value of merged entity, you can say 3 crore 20 lakhs, or you can say that 32 lakhs. Oh, 32 lakhs you get, right? Yeah, 32 lakhs, 32 crores. Not written zero properly. Yeah, 32 crores multiplied by 1 minus promoters holding. 1 minus 0.5445, 54.45, right? Yeah, 54.45. So 32 crores into 1 minus 0.5455. 14 crore 54 lakh 40,000. Yeah, I have taken 32 crore. You can take 3199. That will give you slightly more lesser, but approximately that is 0.45. 1 minus 0.5445. Okay, into 32 crores. 14 crore 57 60,000. Okay, 14 crore 57 60,000. Yeah, approximately 1457 lakhs. Yeah, approximately 1457.6 lakhs. Yes. Okay, good. So that is the end of this merger problem.